Okay, so that was on Thursday. We started with our intervention class. We started with our revision class. So per our arrangement and or per our timetable, today is supposed to be the last day, the last meeting of the advanced taxation. Then you should be ready to sit for your exam, and I'm sure that should be next week on 3rd of July. So we'll look at a couple of issues, couple of questions from question 1 to question 5 during our last meeting. And those questions were our mock examination questions. So today we will continue solving the questions and be doing the revision side by side. So we'll be solving the question and we will try and link the questions to other issues and revise in general. Because apart from today, I don't know if we'll be able to meet again before you sit for your exam. So today we have at least 4 hours to do something. But the questions I have in the intervention document, there are 16 questions. There are 15 questions. So last meeting we did 5. That means we have 10 questions to do today. So today we should be a bit faster so that we'll be able to finish all the questions and revise other issues too as well. Let me remind you again, I'll be saying it for every taxation exam you want to sit for, you need the principles. Without the principles, I'm not sure you can be able to provide convincing answers to the questions that will come in the exam. And the examiner will be able to give you your required mark for you to pass the paper. So you need to understand the principles. You need to understand the principles. It's very, very important. Very, very important. But before we start, let me find out if somebody have any question to ask, any submission, any contribution. Maybe you were going through something that you were confused about, and you would like to ask. If you have, you are that person here. If you are here and you have something to ask, this is the time. You can kindly do that before we move forward. Okay, so I believe there is no questions and we are okay with the things we have been learning so far. So without wasting my time, let's start with the question 6. Let's start with the question 6. And the question 6 is, I'm sure this is the last diet question. March 2024, their question number 4. This is it. This is the question that the examiner tested students' understanding on. And this is the only calculation question that came in last diet. All other questions were ratings, principles. So if you don't understand the principle, how will you be able to answer those questions? So this is the only calculation question that came. And this question is on long-term contract. It's on long-term contract. And the requirement, the first requirement is that the candidate should compute capital allowance. They should compute capital allowance for 6 months. Then the second requirement is candidates are required to explain the tax rules on long-term contract and compute the percentage of contract completion of the project. So you have to explain the tax rules regarding long-term contract and compute the percentage and compute the percentage of contract completion of the project. So taxation rules on long-term contract and the percentage of contract completion. Then the last requirement, which takes 10 marks, is you have to compute chargeable income of Finstrat Limited for the 2022 year of assessment. So this question, if you don't know the taxation rules regarding contract, how will you be able to do it? But notwithstanding that, there are a lot of things in this question you can do, at least. If you are not able to explain the taxation rules on a long-term contract and compute the percentage of contract completion, capital allowance there, you can calculate the one for the 6 marks. Capital allowance, you can calculate it. So the 20 marks, you cannot go home with 0. It's not possible. The capital allowance, you should be able to complete that one. Very, very simple. But it will shock you that if you read the examiner's comments on this question, candidates were not able to compute the capital allowance. So the examiner said, even though the question is straightforward, most of the candidates were not able to compute the capital allowance. So in general, this question 4 constitutes the lowest mark, that the question that the candidate performed lowest in, apart from all the 5 questions. So it tells you that if you don't know the tax principles, questions will come and how you answer it, it will be a bit difficult. So I'm pleading with you guys, let's do our best to know at least the principles that will help us to get our 50 marks. Okay, so who will read for us today? Who will read for us today? Auntie Agnes. Is Auntie Agnes here? I can see the name, Agnes.
Yes, sir.
Are you busy or you are free that you will be able to read for us?
I'm free for now. Yes, I'm free now.
Okay, all right. So kindly take the question.
Okay. Okay. Question 6.
So before you move, Auntie Agnes, before you move on, the questions, what I normally do is, if you read the question, we will try to digest the contents of the questions. We start to explain what will be the treatment of the items in the question before we start solving. Even though when we do that and we didn't even solve the question, but at least you can solve the questions on your own. So we'll use the same approach today. So Auntie Agnes, kindly start the reading for us.
Okay, please. First Tracts Limited has been awarded an airport terminal project. The project started on 1st January 2022 for a contract sum of 60 million Ghana cedis. The construction of the airport is to be completed on 31st December 2023.
Okay,
First Tracts Limited has a financial...
Auntie Agnes, wait. So in every tax exam question, you should be able to, if you have a question on capital allowance, the very first thing you have to do is try and identify the sector of the industry that the company in question belongs to. So try and because that will have effect on your capital allowance computation. That will have effect on your capital allowance computation. So in this question, we were told that FinStrat has been awarded an airport terminal project. And the project started on January 1, 2022. So the contract sum is 60 million Ghana cedis. And the contract is about construction of airport terminal. So this is this to tell you that the company is operating in what? In the construction sector, in the construction industry. So you have to take note of the industry that the company in question is operating. All right. So in long-term contracts, that always the examiner will give you the contract sum. So the contract sum denotes the total revenue, the total revenue that will be gotten or that will accrue to the contractor at the end of the project. And we know that long-term contracts are contracts that expand for more than one financial year. So the contract will last for at least more than 12 months. So if the contract will last for at least more than 12 months, then it will be classified as a long-term contract. And if the contract is being executed by a non-resident company, which is doing the contract in Ghana, let's say if in this question we were told that Fintrust is a non-resident company in Ghana, let's say Fintrust is situated in USA. This will mean that the contract will be creating what? Will be creating what we call what? PE. It means that the contract will be creating what we call permanent establishment. But in this question, no information is given like that. So we assume that Fintrust is what? Is a resident company that is constructing the airport terminal. So the total value of the contract is 60 million Ghana cedis. All right, so let's move on. Take note of that.
Finstruct Limited has a financial year ending on 31st December each year. On 31st December 2022, the accounts appropriate to the airport contract contained the following.
Okay.
The cost of construction materials. We have direct wages of construction staff and project managers, other costs, which includes hire of special equipment, cost of soil test, purchase of fuel and lubricants, consultancy services. Additional information. Materials costing 340,000 Ghana cedis sent to the sites were returned to the company's warehouse.
Okay, so
Should I proceed?
No, wait. The first additional information, how are we going to treat it? So we were told to compute, I think, chargeable income. That's the last requirement. The last requirement of the question is we are to compute the chargeable income, only chargeable income. So when you are computing chargeable income in the long-term contract, you must determine the cost of completing the contract. Okay, wait, let's do some quick recap on the long-term contract before we move on. So let me get that note. Where can I locate that note? Is it under imposition of tax? Let me see if I can get that note. So it should be under imposition of tax and company taxation. Is it under imposition of tax? I'm sorry, guys, I've read that. And we have done it, Clara. Where can I locate long-term contract? Okay, let me check withholding tax and see. You guys, you are telling me that you have not seen long-term contract in the note. I've seen it. Okay. So let's move on. So you see the long-term contract, it means a contract for manufacturing, installation, or construction and related services, and which is not completed within 12-month period. So the contracts have to last for more than 12 months. Then the contract can be grouped as a long-term contract. Now, how do you determine chargeable income? So how do you determine the amount that will be included in calculating the chargeable income of the company for the basis period end? So amount to be included or deducted in calculating the person's income, that relate to the long-term contract is taken into account on the basis of, so this is the basis, on the basis of what? Of the percentage of the contract completed within each basis period. So it means that within each basis period, let's say if the contract is awarded in 2012, so from January to December 2012, which is the basis period, you must be able to determine what? The percentage of contract completed. Now, how will you determine that? So let's see how to determine that. So the percentage of contract completion is determined by comparing the total expenses allocated to the contract. So total expenses allocated to the contract, you compare it as determined by what? By the time of commencement of the contract. So the time of commencement of the contract, the contractor must be able to determine the total expenses that will be incurred to complete the contract. So you compare that figure to what? To the cost incurred. Where is that one? By comparing the total expenses allocated to the contract as determined at the time of the contract. So the total expenses to be incurred to complete the contract, that should be determined at the time the contract is signed. So you compare that with the cost incurred, at the basis period end. So let's say if you have a contract, that the contract sum will be 20 million. Let's say 20 million. And the contract is awarded in January 2012. So by December 2012, you should determine the cost that you have incurred. So let's say if you have incurred 10 million by end of December, so you must, how do you determine the percentage of the contract completion? So that will be 10 million over the 20 million by 100. So that will give you 50%. So it means that for the first basis period, January to December 2012, the project completion level is at 50%. So the cost that you are going to include in calculating the person's income, or the income that the person can include in his chargeable income for the financial year in 2012, will only be what? 50% of the total revenue. So let's see, this is the total cost. This is the total cost. This is the cost. This is the cost you are going to incur. So let's say if the total cost, this is the cost that you have determined, and this is the cost incurred, cost to date. So let's say if the contract sum is what? Is 30 million. So the amount of the 30 million that can be included will be 50% of the 30 million, 50% by the 30 million. So that will give you 15 million. So it means that for the first financial year ends, the contractor can only include 15 million as what? As income. Then you will include 10 million as cost incurred for the first basis period. I hope that is clear. I hope that is okay. So let's go to our question. Good. So in this case, in determining the chargeable income, you must be able to determine what? The cost to date and the total cost to complete the project. Then you find your percentage, you apply the percentage to the revenue and the total cost, the difference will give you the chargeable income. So let's move on. So the first requirement, we were told that cost of construction material is 25,500,000. And we are given additional information that materials costing 340,000 Ghana cedis sent to the site were returned to the company's warehouse. So how do we treat the 340 million? How do we treat the 340,000, rather, not 340 million?
I think it will be subtracted to get the actual materials used for the
Okay,
contract.
so this will be subtracted from the 25,500,000. Okay, so the next additional information, let's move on.
II. Materials sent to the site worth 675,000 Ghana cedis were still unused.
Mr. George, kindly unmute for us. Kindly mute your mic for us. All right, thank you very much.
Materials sent to the site worth 675,000 Ghana cedis were still unused as the construction site as at 31st December 2022.
Okay, you wait. Let me attend to this, Mr. Lumo. Mr. Nathaniel, can you unmute and talk to me? Mr. Nathaniel, if you can hear me, can you unmute and talk to me, please?
Yeah, I can hear you.
You said, can you get the note? Is it
Yes.
the question you are talking about?
No. The notes you just showed.
Okay. Then you have to, that means you are not on the WhatsApp page.
No.
Okay.
I registered last September. I couldn't write. It was this sitting I'm trying to.
Okay, so you send me on WhatsApp. I'll forward them to you.
Let's move on when we are done.
Yeah, when we are done, I'll give them to you. Okay. So the second information, materials sent to site worth 675,000 Ghana cedis were still unused. So how do you treat the unused material? So this one, it means this is the closing what? This is the closing stock. So how do you treat it? Let's be fast. Today we have to move faster because we have a lot of things to do today.
It will also be subtracted.
All right, so this one will be deducted from the cost of construction materials. Okay. The third information.
Finstrax Limited pays some of its workers the first week of the ensuing month after the end of the current month. In view of this arrangement, 57,000 Ghana cedis is still owed for wages as at the close of the year 2022. This was not included in the accounts.
Okay, this was not included in the account. So how do we do to the 57,000? This is owings, wages owings. They didn't pay it at the end of the year. So how do we treat it? We have to add it, Anna. We have to add it to the wages paid for the year. Is that not it?
Yes.
All right. Okay. So next information. Let's move forward.
Okay. A bill amounting to 45,000 Ghana cedis was submitted late by Finstrax Limited, and as at 31st December 2022, the bill had not yet been paid. This was not included in the accounts.
So how do you treat the 45,000? The company submitted bill amounting to 45,000, which was not paid by the owners of the contract. So this bill was still outstanding. So how do you treat it?
You add it.
We add it. So this is an outstanding bill. So it should be part of the cost. So we add it. The next one.
To determine the estimated profits on the contract, it was estimated that the cost to complete the project as at 31st December 2022 should be 8,265,180.
What does this statement mean? What are they talking about?
They're talking about estimates in the future.
Estimate in the future. So they are saying that before you can determine the profit from the contract, additional cost of 8,265,180 Ghana cedis have to be incurred before the project can be completed. Is that not it? That the cost to complete the project as at 31 December 2020 should be this. So it means the cost that they have incurred, they still have to incur additional cost of this amount, 8,265,180 before the project can be completed as at the end of December 2022. So this one, it means that while we are able to determine the cost to date, we have to add this cost. So before we can get our total cost of completing the contract. So while we're able to calculate the cost that's already been incurred, we're able to calculate the cost of material that was sent to site, the cost of wages, cost of soil test, cost of fuel and consultancy services. These will be the costs that have been incurred to date. So before you can be able to complete the contract and claim your profit, they are saying that you have to incur additional cost of this amount before you can be able to complete the contract. So while you're able to determine the cost to date, you have to add this amount to it before you can get the total cost of completing the contract. Let's move on. If you have any question, you are free to ask. If you have any question, you are free to ask. Auntie Agnes, let's go on. Okay, so we are giving assets. We are giving assets. Okay.
Yeah.
All right, we are giving assets. Good. So should we start solving the question at once, or we should continue the way we
So
are
we have.
Okay, so let's go. Let's classify them. If you are not able to solve the question, I believe you can do it on your own. So let's classify them. So let's Agnes. So we have
Okay, trucks and trailers.
okay, so this is the
We have the
written
written down
value at the beginning of 2022, 420,000 Ghana cedis. So during the years, 600,000 value of trucks and trailers were acquired. None was disposed. So trucks and trailers, which class will it belong to? This is construction sector. This is construction sector. So there are trucks that they use, there are trailers that they use to do the construction. Which class will it be? Mind you, we are answering the additional for the first requirement to computation of the capital allowance for 6 marks. The classification is very, very important. That's the reason why I told you from the beginning that you have to know the industry.
Class 2.
Class what?
2.
Class 2. So this will be class 2. Okay. So within the year 2, we add additions. All right. Electric, ceiling, and standing fans. Which class? Ceilings and standing fan. Which class? I'm not supposed to do this classification for you. In the chat box, I will not be reading it constantly. So if you are talking,
Class 3.
If we are talking, that will move fast. So this will be class what? Class 3. If you disagree, you can bring your submission on board. Then we will look at it. Okay. Window and split air conditioners. Which class?
Class 3.
Class 3.
Class 3.
Okay. Dozers. I mean, this will be bulldozers. Which class?
2. Class 2.
Class 2. Wheel loaders. Which class?
Class 2. Class 2.
Class 2. Computers.
Class 1.
Class 1. Rollers.
Class 2.
Class 2. Data handling equipment.
Class
This one,
1.
class 1. This is the disposal. So this is acquired. So additional acquired. So we add it to class 1. Okay. Then office photocopier. Photocopier which class?
Class 3.
Class 3. Office LED television.
Class 3.
Class 3. Vibratory compactor. Which class?
Class 2.
Class 2. So we add it to the additions. Then hydraulic excavator. Which class?
Class 2.
Class 2. We add it. Motor vehicles.
Class 2.
Class 2.
Class 2. So this one, are we going to limit the value?
No,
What is
sir.
the rule on the
No,
motor
we
vehicles?
will not limit. We will not limit.
Why are we not limit? Why shouldn't we limit it?
Limit. What limit?
Aha.
Because when you go down, you see, this one is a motor vehicle,
Aha.
and no issue was said about either it is a saloon car or not. But when you go down, they say a pickup vehicle.
Aha.
So the pickup vehicle, you know that one, because it's a pickup, it's a saloon car, and that one will be subjected to the limitation rule, which is the 75,000, 750,000, 75,000. You understand? So because this one they didn't say anything about it, we assume that it is the vehicle for businesses, not saloon vehicle.
Okay, thank you very much. This one self, even if you look at even the pickup, you can assume. I told you sometimes assumptions work. So looking at the sector, the industry sector is construction. It's construction sector. So it could be that the pickup, you can assume that because the pickup is used in the construction industry, you can see between the value and do your computation. So the pickup, even though
for the pickup,
you said?
You mean for the pickup?
Yes, for the pickup,
You
yes.
can still maintain that value.
You can still maintain that value.
Okay.
So you state your assumption that the assumption is that the pickup is used in the construction sector. So the value should the value should not be limited to the 75,000. Is that okay? You can assume that the pickup is used in the construction sector. So you will not restrict the value and still use the 140,000. You will get the correct answer. So even the motor vehicle somebody can equally limit it.
Can assume and limit it.
Yes, somebody too can assume and unlimit it and restrict the value to the 75,000. Yes. Somebody too can do that. Yes, somebody too can do that. So if you also assume that because the pickup is used in the construction sector, so in that case, you will not restrict the value. Your assumption will be right and the examiner will mark you correct. So let's go. Visitors chair. Visitors chair. Which class?
Class 3.
Class 3. The office chairs and tables, class 3. Office building, class what?
4.
Class
4. File cabinet, class what?
Class 4.
Class
3.
Then the vehicle, class 2. Okay. So this one, even if I don't solve the question, you can solve the question already. So they say the values of the assets sold during the year were all cash. So they sold all the assets for all cash. So the disposals you know what to do to the disposals. You have to take the disposals off. You know what to do to the disposals. Okay. Now, they are saying that the building at the start of the year 2022 was constructed, 6 years ago. Take note of this information. And 6 years capital allowance has been granted. So what do you do here? What will you do here? The building, this is the building value, 916,000.
You have to determine the written down value as at today.
We are giving the written down value at the beginning of the year. You are giving that is the 916.
Okay.
The written down value as at January 2022. We are giving that you can see here. So the all first values were the written down value. So what do? We know that class 4, the capital allowance is on what basis?
10% on straight line.
Class 4 is 10% straight line. Is that not it?
On straight line.
On straight line.
Yes.
So that means 10% on cost. It's not 10% on cost.
Yes.
Good. So you are told that
Yes.
the building, this value, the 916,000, the building was constructed 6 years ago, and they have enjoyed
Is the written
60%
down
of the
value.
capital allowance. So what will you do?
So we have to convert the written down value to the original cost 6 years ago.
Okay. So how do you do that?
Then we um so um it seems that should be divided by 0.6.
Charlie, your voice is down. Me, I cannot even hear you.
Yeah,
Why? Are you tired?
I'm saying that
Uh-huh.
I'm tired of Charlie. I'm saying that
Mm.
we will do 916,000 divided by 0.6.
We do 916,000 divided by what?
0.6.
What will you get? Should it be 0.6 or 0.4? Should it be 0.6 or 0.4?
I think
0.4,
4.
0.4,
Yeah.
0.4,
It should be what?
Yeah, 0.4.
0.4 rather.
Okay, all right. So it will be 0.4.
So that will give you
So that will give you 2
2
what?
million.
that will give you 2,290,000.
2,290,000. So this is the cost. So just apply the 10% to it. Then to give you the capital allowance. So the capital allowance will be what? 229,300. So that will be the capital allowance. So this one, I'm just trying to play some small trick here. Small trick over here. So if you don't know, you go straight forward and multiply the written down value, 916,000 by 10%. You will get it wrong. You will get it wrong. Okay. So we are done. So the capital allowance, I don't know if I should solve the question again. Should we solve the question again? But we are done solving the question. I don't have much time, so we are done solving the question. So I just explain the things to you. So this one, I just going to add the figures together. Just going to add together and deduct. That's all. You know what you do to the additions. Additions you add. Then the disposals, you deduct them. Then that what you get will be the depreciation base. Then you just multiply by the percentage. So class 1 is what percentage? So capital allowance. Class 1, what's the percentage of class 1?
Class 1 is
40%.
40%.
Reducing what?
Reducing balance.
Class 2.
Balance.
Class 2 is what?
30%.
30%. Reducing balance. Class 3. 20%. Reducing
20%.
balance. Then class 4 is on the 10% straight line basis. Then class 5 is the cost over the useful life. So we'll add the figures together and calculate your capital allowance. But we will need the capital allowance figure in computation of the chargeable income, because capital allowance is an allowable deduction. So you need the capital allowance figure. I hope you guys have solved the question. Who have solved the question? So the person can just give us the capital allowance figure, then we will use it. Okay, even if you don't have, when we get there, I will leave that column for you. You go and do it. So that's how you calculate your capital allowance. So explain the tax rules on the long-term contract. We have done that already. And compute the percentage of the contract completion. So how to compute the percentage, I think I've done that in the note. And we have even explained the tax rules already. So the rule is that the amount that should be included in calculating the personal chargeable income should be what? Based on the percentage of contracts completed during each basis period. I've said that already. So how do you determine the percentage of contracts completed during the basis period? So you find your cost to date divided by total cost to complete the project, then multiply by 100. So that will give you the percentage of contract completed at the end of the basis period. So when you get that, you just multiply that percentage by the contract sum. That will give you the revenue that the FinStra should to include in their chargeable income. Then what will be the cost? So the percentage, you apply it on the total cost to complete the project. It means that that is the cost incurred at the end of that basis period. You deduct the total cost from the total revenue, the amount you get to give you your chargeable income. The amount you get to give you your chargeable income. So should we solve the question? I'm even done. I'm done. So let's move on to question 7. Any question? Any?
Yes. Let's solve it.
Let's do it. Okay, then let me solve the B part.
Please,
I'm such I cannot hear you.
if you can help us solve it.
If I can help you solve it. Okay, so
Yes, please.
so today I cannot be sharing the 2 screens because I'll be writing. So I cannot be sharing the 2 screens. So what we'll do is, so let's compute. So that means you have to be fast and be giving me the figures. If not, we will delay today. So what's the name of the company? So FinStrat Limited. So we are doing computation of capital allowance. So this is the first requirement. Good. So let's compute the capital allowance. Mind you have to write the basis year end. Don't forget, you write the basis year end and the year of assessment. Good. So we have our class. We have our class 1, class 2, class 3, class 4. Then let me put the total here. So class 1, let me put 30 at the top. So class 1. So we start with the written down value. So what will be the total written down value for class 1? What's my question? So class 1, we have what? We have computers here. Class 1, we have computers. 50,000. The other class 1 is it will be addition. Is that what it? It will be addition. Good. So this is 50,000. Then class 2. Add all the class 2 for me. 4. Somebody should be adding fast. 420,000 plus the other class 2, 760,000. I hope somebody is adding. Okay.
Yes.
Yes, sir, we are adding, sir.
The other class 2 is 1,260,000. Then another class 2, 540,000. Any class 2 again? The motor vehicle, class 2. Any, okay, this one is an addition. So what's the total written down value for class 2?
$3,610,000.
3,610,000. Okay. Let's go to class 3. Let's go to class 3. So we have 60,000 ceiling fan, 71,000. Class 3, class 3, class 3. 7,000, 6,600. Which one again? We have 3,000. We have 35,000. And then class 3 again, yes, 15,000. So what will be the total?
1,976,000.
1,976,000. Okay.
600.
So the class 4 is what? 961,000. All right. So the additions. Class 1. What will be the total addition? So class 1. We have I saw data handling somewhere. How much is it? Yes, here. Data handling, class 1. So that's 35,000. Class 2. The additions for class 2. Let's add them fast. So we have 600,000. We have 600,000, class 2.
Continue.
Which one again? Class 2. We have
900,000.
900,000.
900,000.
580.
580.
670.
670. Then the pickup.
And 140.
140. What will you get?
You get 2,890.
2,890. Class 3. Additions for class 3. Class 3 additions. So we have 8,000. Any addition for class 3 again? Okay, 20,000 is here.
20,000.
So that's 28,000. So that will give you 28,000. There's no addition for.
Hello.
Yes, I can hear you.
Are you carrying 3 zeros?
Yeah, 3 zeros at the top. 3 zeros is at the top.
And so the written down value for class 2 is plenty like that.
In the question, what are the values? 3 zeros there, the question top. There are no 3 zeros, yes. There's no 3 zeros on top of the question. So then let me remove my 3 zeros. Let me take my 3 zeros off. I thought there were 3 zeros on top of the question. Okay, let's move on. So there are no additions for class 4. So we add. Let's even take the disposals out before we do that thing at once. So let's do the disposals. So any disposals for class 1? class 1, 22,000.
22,000.
So that is the only disposal for class 1. So we take your 22,000 out. Class 2, any disposals?
Yeah, there is.
How much? Why? Where's my question? My question is loss.
It has come.
This one, the way it's coming to be disturbing me. Coming. The way it has done, it will be disturbing my work. Let me look for it and come. Why is it? Valley, the thing is gone. Okay. So let's move on. So we are on disposal saying class 2. Is it class 2 that we are on? So disposals for class 2, add. That will be 80,000. So disposal for class 2, that will be 80,000 plus what?
200.
200,000 plus the
60,000.
60,000. Good. That will give you how much?
340,000.
340,000. Other disposals for class 3. Class 3. Okay.
Office chairs, 5,000.
Yeah, 5,000 was disposed. I think that's the only thing.
Sure.
Good. So 5,000. So we are done with our disposals. There's no disposals here. So our depreciation base. So the depreciating base for class 1 will be how much?
63,000.
63,000. Class 2.
Can you mention the first figure for me? The written number, I can't see it well.
3,610,000.
Okay. 6,100 6,160.
6,160. Class 3.
1,000.
Class 3.
220,600.
220,600. So that one 6,000. So calculate the capital allowance for me. So this one, are we doing it?
25,200.
Are we doing the capital allowance full year?
Yes, please.
So what's the formula for the capital allowance? So capital allowance is equal to what?
A
by B
by B by all over 365.
365 days. A means what?
A is the depreciation base.
B is the rate, and C is what?
Number of days.
So while you are doing the capital allowance, you have to take note of what? The date of commencement of business. Is that not it?
Yep.
Good. So this one, the person was in business for long, so it will be full year. So it will be 365. So it will be 365 over 365. So this one to cancel. Good. So the capital allowance for class 1 will be 40% on 63,000. That'll give you how much?
25,200.
25,200. So find the written down value for me at once. So written down value at the year end. This will be how much?
37,800.
I don't agree with you. 63,000 minus 25,200.
Do you have calculator?
37,800.
30.
7,800.
Okay. Hey, my boss. He said, I don't have calculator. Class 2.
You have calculator, you say you don't agree with me.
I think the figure to be more than that. Class 2, what's the capital allowance?
18,48,000.
18,48,000. So what will be the written down value?
43,12.
43,12,000.
Yes.
Class 3, capital allowance.
44,120.
44,120. Written down value.
176,480.
Okay. So class 4, capital allowance. We have done that calculation already. What did we get? 229. Is that not it? We have done that calculation already. Is that not the case? Is somebody confused about the capital allowance for class 4? So what will be the written down value?
687.
687,000. So total capital allowance will be what? 25,200 plus 1,848,000 plus 44,120 Ghana cedis plus 229,000 Ghana cedis. What will it give you?
Two 146,320.
2,146,320. So this is your capital allowance, which will be granted to Finstrat Limited as a deduction. So we are done with the first requirement for 6 months. And nobody did all these things. Nobody did the whole thing. I have the full mark. So let's go to that. We've done the B already. So let's do the C. So C, we are to do what? C, we are to compute chargeable income, only chargeable income. All right. So let's do that. So C will be computation of chargeable income. Good. So what do we start with? Start with the cost. I told you have to know the total cost. Where am I going? You have to know the total cost to date. Then you compare that with the total revenue. Then to give you your chargeable income. Good. So we have the material cost of construction material. So we have material to site. How much is it? To 25,500,000. So we less This one you had the discussion already. Material returned. Which is how much? 340,000. With less closing stock of materials left, which is 675,000. So when you let this one, the total cost material used will give you how much? Do the subtraction for me fast.
24485.
24485. Good. Then we move on to the next cost, which is what? Which is the labor cost, higher of special direct wages of construction workers. So go to the labor cost. So we have the wages paid. How much is the wages paid? How much was paid? You have the question with you, so just give me the figures. Let's move forward. $22,100,000. Then we add the OEs of 57,000. How much will you get?
22157.
22157. What are the other costs? We have hire of special equipment, cost of sweat test, purchase of fuel and lubricants, consultancy services. Okay, so let me add them. So we have hire of special equipment. How much is that?
300.
I didn't 300,000. Is that it?
Yes, 300.
Okay. The next cost is what? Cost of fuel test. How much is it?
100,000.
100,000. The next cost is fuel and lubricants. How much?
750.
750. Then we have, which one again? Consultancy. Consultancy services. How much is it?
I'm not sure that one. I didn't see it well before you change the screen. So I don't know. It's 135 or so.
You don't have the question with you.
No.
Okay. Then we add,
135.
okay, we have, there's one in the question. I spoke about it earlier. Which one is that one? The outstanding bill, yes. A bill amounted to 45,000 was not paid. So we add out
Bills owing.
outstanding bill. How much? 45,000.
Mm.
Then we add what cost again? The capital allowance. Which was how much? You've got 2,146,320. Why are we adding the capital allowance? So what will be the total? What will be cost to date? Cost to date will be how much? By now, you should be finished with the additional.
Please scroll to the top.
That means you are not writing.
Oh no, I'm not writing.
Okay, add for me fast.
5,011,8320.
Wait, let me scroll up small. 5 what? 50
No.
1
320.
Okay, so this is the cost today. So you have to add, I explained that one earlier, you add cost to complete. Which is how much? I explained that additional information earlier. This cost to complete. You have to add it. Before you can complete the project and claim your profit, you have to incur this additional cost. So how much is that? 8 million what?
8,265,180.
180. So what the total cost to complete? So total cost to complete.
58.
58.
383. 500.
So this is the total cost to complete. Now we must calculate the stage of completion because we are asked to calculate what chargeable income for the financial year in 2022. So you have to calculate the stage of completion. So I told you that one, the formula is what? Cost that you have incurred to date, cost to date.
So the total cost to completion is 58,333,500.
Someone else to confirm that figure for me again. So is the figure 58333 or 58383? Which is 6.
265.
Mr. Amposa, I cannot hear you.
Oh, okay. So if that one is 6, then the answer is correct.
Okay, thank you very much. So the stage of completion will be cost to date over total cost to complete multiplied by 100. So 118,320 over 58,383,500 multiplied by 100. So what percentage is that? They are not 100.
66%.
You say what?
85.84%.
85.84%. Good. So let's calculate our chargeable income now. So our chargeable income will be equal to what? So
What did we calculate now?
this is the stage of completion.
Stage of completion.
Yes.
So we use that one to calculate the chargeable income.
Yes, exactly.
This one, it looks new to me.
It looks new to you. This is long-term contract. That's the reason I'm solving the question. I brought this question up, but I know it to be new to everybody or to most of the candidates. So the chargeable income will be what? You have to get, let me do it very well. So our chargeable income. So you have to get the revenue. So that will give you 85.84% multiplied by what? What's the contract sum? Contract sum is what? 60 million. Is that not it? Is the contract sum 60 million? The contract sum is 60 million. I think it's at the top here. Started explaining from that place. This is the contract sum, 60 million. So it means that for the financial year end 2020, for the year of assessment in 2022, Fistrat Limited cannot claim all the 60 million because they
Once
are.
two niabo. Once two niabo fair practice.
Mr. Zado, what are you practicing?
Well, sorry.
You're welcome. You also want to practice some. So how much will you get? 85.84% or 68 million. How much will you get?
51,504,000.
51,504,000. So the cost. So the cost will be 85.84% by what the total cost to complete 58,383,500. How much will you get? Why? You guys, your calculator is dead or what?
501163.
501163.
501163
63.
what?
96.4.
So how much will be the chargeable income?
You know how the 0.4.
Let's do it to the nearest whole number. So your chargeable income will be what? You actually give you one something.
138,764.
137,604. So this is your chargeable income. Then you are done for your 20 months. Another question. Then we go to question. Let's go to question 7. I believe that there are no questions. Auntie Agnes, are you here?
Yes, sir.
Okay, read the question 7 for us.
Okay.
I want us to do something on mining and petroleum before we close soon. So let's be fast.
All right. Question 7. Mr. Kwame Beku graduated from the University of Ghana in 2017. In 2019, he secured a Government of Ghana scholarship to pursue a master's program in agricultural science at the University of Alabama in the United States of America. During the course of the master's program, he developed unique ideas on how to establish a commercial farm and also engage in the processing of the farm products. On his return to Ghana, he decided to implement the ideas developed during his time at the University of Alabama. His business plan shows that he intends to establish a farm to grow coconut and as well as an associated factory to process the coconut into milk for domestic consumption. Establish a poultry farm to produce chicken and eggs for domestic consumption. Mr. Beku has submitted his business plan to you for tax advice. Required. As a tax advisor of high repute, advise Mr. Kwame Beku on the following. A. The income tax benefits of farming coconuts and establishing a processing factory. B. The income tax benefits for establishing a poultry farm. C. The most appropriate place in Ghana to establish the farms and the factory in order to derive maximum tax benefits.
Okay, thank you very much. So this question, what the examiner testing here?
Location incentive normal is part.
Okay.
We also have the manufacturing, two type of manufacturing. That's agri-processing business. That one, so they are testing our knowledge in it.
Okay.
Then importation and exportation, or we can bring in the other one, the free zone one.
Free zone what?
We can bring in the free zone. When you want to grow the coconut in a free zone area, then we will give you some.
Okay, thank you very much. Okay, so you are to advise Mr. Kwame Beku on what tax benefits that he will enjoy for farming coconut farm and establishing a processing factory. So what will be your advice? They say what the man went to school in where?
USA,
He went to school in the United States.
big man.
So he went and did his master's course. Don't worry, don't mind him. You have money to go to school in USA.
No, it's scholarship.
Scholarship. And he went and did master's in agric. Okay, so and he heard about the commercial farm also engaged in the processing of the farm produce. So on his return, he have two business plans. One is to establish a farm to grow coconut. So this will be what? Coconut what farming? Is that not it? Coconut farming is under which category of industry? Three what? Three crops. Is that not it? Then he will as well what establish a factory to process the coconut into milk. So this will be processing factory.
Can we say agro-processing business?
Is it agro processing?
Yes, it's
I don't know.
agro-processing.
Okay.
Because the coconut is an agricultural product.
It's agro processing factory. Or you can as well assume that it will be a manufacturing factory. To be a manufacturing factory. You can assume the two and write on it. Can assume that the factory will be agro-processing factory or manufacturing factory and explain the tax benefit of any of them. You will get your mark. Good. So now, if Mr. Kwame Beku want to go into coconut farming, which fall under three crops, what is the tax incentive there? And if you want to go into farming three crops, what's the tax incentive there? Should I go to the note or we will bring it on? Should I go to the note? Which note? Is it withholding tax? I believe so. I will
No,
not
to be withholding tax.
I'll-
The note doesn't want to remain in our head.
Is it? So coconut farm, as I said earlier, okay, then let's refresh our mind. Coconut farm, as I said earlier, form under three crops. And a person who engage in the three crops is subject to what? To pay tax at the rate of what? 1% for a period of how many years? For a period of 10 years. Now, this question, I intentionally leave it like this so that to test your mind and see what you will tell me. The rate, is it still 1%?
No, it's 5%. I wanted to say that.
You wanted to say what?
that rate, the 1% you mentioned, is that the new law or the old one?
So what's your submission on that?
The new law is 5%. So.
The new law is 5%. So this one has 1% has been changed to 5%. Is that not it?
Yes.
This one, the 5% take effect from which year?
Year of establishment.
No. The old act under the act 896 of 2015. Eh?
Mm.
This one talk about the 1%. But the amendment was done recently. Is that 2023?
Yes.
So 2023, the act was amended. So the 5% take effect from 2023. That was last year. You see, so this question, I intentionally left.
Is that the question you're asking me?
That's the question I'm asking you.
Oh, I thought you were saying that when are we going to start applying the 5% to
No,
the
I said
company?
I said the 5%. When is it taking effect?
Sorry.
Which year? So in this question, I intentionally left the year to be 2019 and see the rate that you use. Are you with me?
Yes.
So if it is 2019, then 1% will hold. But you will not see 2019 in the exam question. The question would it will always be on, maybe it will be on 2023. It will be the year before the year, the examination year. So it will be 2023. But pay attention to the year. So I intentionally left the year in this question to be 2019 and see the rate you mentioned to me. So if it is based on this question, the rate will be what? 1%. So if like the question is talking about 2023, then the rate will have be 5% for 10 years. I hope that makes sense. All right.
Yeah.
Good. So that's the incentive. If you are into a tree crop, you only pay tax at the rate of the current rate of 5% for a period of 10 years. So that's the incentive that Mr. Kwame Beku can enjoy. So you only pay tax of 5%, or by per this question, it will be 1% for a period of 10 years. So what about the factory? If you want to engage in the factory, so the factory will be classified as what? Agro processing. If that's the one you are choosing. So for the agro processing factory, what the incentive there? So the old rate, they will also pay tax at the rate of 1% for how many years? For 5 years. But the new rate is 5% for 5 years. So what about if you want to go into manufacturing business? What is the tax incentive for manufacturing business? But in this question, it will be agro processing. So the best one you should choose is the agro processing. But what about if you select manufacturing business? What is the tax incentive for manufacturing business? What will we talk about? I'm waiting. Manufacturing business, what is their tax incentive? It's not only the locational incentive. So it's only the locational incentive, which any other business will enjoy. So the best advice would be that he should go into the agro processing. The best advice, what you choose should be the agro processing. Good. Now the other one, if you want to go into poultry farm and produce egg for domestic consumption. If you are going into poultry farming, what is the tax incentive for poultry farming? Poultry farming will fall under which one? Which category of business? Poultry farming will fall under which category of business?
I don't know if I should say livestock.
That is it. It's fall under livestock. A person who is into a livestock business, what the tax incentive? For a period of 5 years, they pay tax at the rate of what? 1%. That's the old one. For 5 years. So now 5% for 5 years. So you paid attention to the year in the question. So you enjoy for a period of 5 years, you only pay tax at the rate of 5%. You only pay tax at the rate of 5%. So the C, what's the most suitable place in Ghana that Mr. Kwame Beko can establish the farm and the factory in order to derive the maximum tax benefit, So where in Ghana should he establish the farm?
You should go to the north.
Should go to where? If you go to the north,
Yeah.
This is why, are you looking at the mark? It's 8 marks. So you say you go to the north for 8 marks. Is that what you tell the examiner that Mr. Kambeko should go and establish the farm in the north? Full stop. 8 marks. How will we start answer this question?
I'll start by telling him that after the 5 years or the 10 years, we'll be paying taxes at this rate. And
what rate? The man didn't know. The man didn't know. So you have to, your presentation must be suitable. Your presentation must, when you read it, he should understand. So you have to explain to him. You have to explain to him before you advise, before you give your advice. So if you are saying this rate, what rate? How will you know the rate?
I'm not going to find out the rate.
You are now going to find out the rate.
Maybe before Wednesday.
Okay. So a person who is into the farm, which is the coconut farm, and the factory, which will be the agro-processing factory. After the concessionary period, what is their tax rate?
I think it's 15%. I'm sure.
What is 50%?
15.
For where?
The agro-processing.
Agro-processing.
Yes.
But first, you have to talk about the two. It's both the farm and the factory. So if you are going into the farm, being it agro-process, the farm, livestock farming, coconut farming, whatever, after the concessionary period, what rate would Mr. Kwa, what would be the tax rate? So what you do is you list the tax rate applicable to each of the location. Then you advise him. So for farming business, being a tree crop, poultry farm, livestock, cattle farming, and the rest. After the concessionary period, take note, Accra and Tema, the rate is what? 20%. Then other regional capitals, other regional capitals, the rate is 15%. Then outside, where I'm writing the thing, is it okay? Outside the other regional capital, the rate is 10%. Then in the northern region, The Northern Savannah Ecological Zone, the rate is 5%. This is for the farming, livestock, coconut, tree crop, cattle farming, whatever. After the concessionary period, Accra, if you are located in Accra and Tema, you pay 20%. If you are located in other regional capitals, apart from Accra and Tema, other regional capitals, apart from the northern regions, the 3 northern regions, you pay 15%. If you are located outside the regional capitals, you are located anywhere outside the regional capitals, and apart from the northern regions, you pay 10%. But if you are located anywhere in the 3 northern regions, you pay 5%. So that's the advice. So based on that, you advise Mr. Kwame Beku where he should site the factory. So like what we said, he should go to the north. Okay, that's good. He should go there so that you pay a minimum tax rate of 5%. Is that not it? You should go there so that you
That's what
pay.
I want to say.
So that you pay.
I know the rate at the north is cool, is smaller than the others, but just I've forgotten the rate. That's why I said
That's why everybody know, every tax person know that the north is cool. So based on that, you advise him to go to the northern region so that he can reduce his tax liabilities. Now, for the factory, what will be the rate? For the factory, what will be
factory there. Say Accra is 25%. Regional capitals. Rebate of 75%. Outside the regional capitals, rebate of 50%. Then the northern, no, there's no northern zone on that one.
Okay, so let me that is it. That's the rate. That one there we know, so I will not talk about it. But for the farming, the rate I just illustrated above is for the next 5 years after the concessionary period. So take note of that. It's for the next 5 years after the concessionary period. Okay. So in your explanation, you say that Mr. Kwame Beku, the factory, the locational incentives will enjoy it. So after the concessionary period, you'll be paying tax at the rate illustrated above on his income for the year. Okay. Question 8. Auntie Agnes, let's
hold on. You say for the next 5 years. I don't understand.
It means that the rates I've illustrated above.
Yes.
The Accra and Tema 20%. Other regional capital 15%. Outside other regional capitals 10%. Then the northern region 5%. Those rates are only applicable for 5 years. For 5 years after the concessionary period.
So after that 5 years, what happened?
After that 5 years, if you are still there, then you still pay the same rate. So it means that it's there as an incentive. So for the next 5 years after the concessionary period, those are the rates you pay. But if you are still in business, you are still there after that 5 years again, then you still pay the same rate. But the law states it. That is what is in the principle, the law. That's what I'm telling you.
Yeah, I understand.
That's what I'm telling you.
This is law, so.
Yes, this is law. So that is what is in the law. That's what I'm telling you. So this one, I cannot challenge it. The tax principle, those who develop it, they know best what they are doing. So
This
let's
tax
go
thing,
on.
you can't do application.
Tax there, what application are you going to do? There's no application in taxation exam. You will be deviating. You deviate and yourself, you know that. You thought you are written something. Over the bar. Tax there, the principles, if you don't know it, it will over you. Question 8. Let's go on. We have more questions to do. Auntie Agnes, let's go.
Question 8. Red Flow Ghana Limited is a manufacturing entity in Ghana. Mr. Kautz Wildem, a citizen and resident of Germany, owns 90% of the company's shares. Mrs. Florence Wildem, a citizen and resident of Germany and wife of Mr. Wildem, also owns 5% of the shares of the company. Mr. Jorgen Wilden, the son of Mr. Kurt Wilden, holds the remaining 5% of the shares in
Right.
the
This why
company.
it be family business.
Can you imagine?
Let's go. So it means that
Okay.
the company
As
have how
at
many
first,
the company have only 3 shareholders.
Yes.
yeah.
Only 3 shareholders. Okay, let's move on.
As at 1st June 2019,
Uh-huh.
the company had a stated capital of 400,000 Ghana cedis.
Okay.
A report submitted by management to the board of directors indicated that the company needs to acquire a plant valued at 1 million Ghana cedis to enable the company increase its production capacity.
Mm.
Mr. Kurt Weldon, who is the majority shareholder, has offered to finance the purchase of a plant for the company, but his challenge is whether to provide the assets to the company as loan or as equity
Okay.
required. Advise Mr. Kurt Weldon on the investment tax treatment of providing the assets to the company as equity contribution. The income tax treatment of providing the assets to the company as a loan. The preferable option of providing the assets to the company in order to derive the maximum tax benefit.
So what will be your advice? This one, the company is made up of 3 shareholders. A man, his wife, and their son. The man is holding 90%. The wife is holding 5%, and their son also holds the remaining 5%. So as at the financial year end, okay, as at June 1, 2019, they have a total equity of 400,000 Ghana cedis. So the main thing in the question is that they want to acquire a plant. The company is in need of a plant. So the value of the plant is 1 million Ghana cedis. So the main reason is that the plant will enable the company to increase its production capacity. Now, the major problem is the majority shareholder, who holds 90%, want to finance the purchase of the plant. But his main challenge is whether to provide the plant to the company as a loan or as an equity. So you are required to advise the majority shareholder, Mr. Kurt Weldon, on whether if you provide the plant as an equity, what will be the tax implications of providing the plant as an equity. Mind you, the value is 1 million Ghana cedis. The value of the plant is 1 million Ghana cedis. So it means he's going to give the 1 million to the company as equity. So what will be the tax implication on that? Then the second one, he will give the 1 million to the company as a loan. So what will be the tax implication on that? Based on the two, the one that will give him the maximum tax benefit, then you advise him to go by that method. So what will be your advice in the examination room? We are many here. Today we are many. So I hope you are enjoying the class.
Roman number 1.
Uh-huh.
So when he provides the amount of 1 million as an equity, it will increase his shareholding in the business. That will be the original shareholding. The total net assets of the business is can you scroll up? Let me just refer to that figure.
400,000 Ghana cedis.
400,000.
Yes.
400,000. So if he alone add 1 million, the total will now be 1,400,000, and his shareholding is 90%, which will make his shareholding in the business to be 1,260,000. And so when a profit is earned and the dividend is being shared, he will take the larger portion of the dividend and will be taxed on it. So it will increase his tax as an individual. So when he provide it as an asset, or sorry, as an equity, it will increase his tax burden. Roman number 2. When he provide it as a loan.
Okay, wait. Let somebody. I know somebody will add to the equity. Somebody want to add to the equity. Then we go to the loan. Let me add. Today I don't have my time.
Yes.
So let me add. So what you said is in place. That is it. So providing the plant as an equity, it will increase the stated capital of the company to 1.4 million. That's what you said. That's very good. Now, a person who holds an equity in the company, the return on the equity is dividend. The return on the equity. These are the things to be right, you know. The return on the equity is dividend. Now, dividend is not deductible for tax purpose. Dividend is not deductible for tax purpose. So it means that the company, they will not have any tax deduction. They will not enjoy any tax benefit on the dividend. But the dividend will increase the tax burden of Mr. Katz and Weldon. So dividend, you have attract 8% final withholding tax. So the dividend will increase the tax benefit. That's what we have said. That's very good. Now, there's one thing that you have to add to get the maximum mark. In the principle under the how do you call it? Let me think. We have anti-avoidance what? Anti-avoidance what? Rules. Yes. I hope you can remember them. We have team capitalization, arm's length principle, income splitting. We have which one again? Profit sharing. We have one called profit sharing. Yes. Now, under the profit sharing, it states that if a company is controlled by not more than, so not more than five shareholders, if they refuse to distribute part of their profit to the shareholders as dividends, the Commissioner General have the power to do what? To come and recharacterize their transactions based on the available information to the Commissioner General and reserve part of their profit as the capital requirements of the business. Then the remaining, you will treat it as dividend. That should be distributed to the shareholders and they will pay tax of 8% on it. So in this question, there are only 3 shareholders. So in case you say what? There are only 3 shareholders. So in case if he provide the asset as an equity, in case they fail to distribute parts of their profits as dividends, the Commissioner General have the power to recharacterize their transactions and give part of their profit to them as dividend and charge what? Tax on it. I hope you can remember that anti-avoidance rule.
Yes.
I've said it. So if you can remember, you add that one to amend your maximum marks. Okay. Now the B part. You want to comment on the loan.
Yeah. So on the loan. So the loan is the interest on the loan is deductible for tax purposes. That is number 1.
Okay.
And so it will reduce the tax burden of the company. However, the interest that will be paid to him will be subjected to a tax of 8%.
No, that one the rate,
withholding,
that one the rate is not 8%.
the withholding tax, the interest on withholding tax.
That one the rate is
Yeah.
1%.
1%.
Wait, I'm coming. The interest that will be paid to him.
Yes, the loan interest.
The
It will
loan
attract
interest-
withholding tax.
Yes, it will attract withholding tax of 8%. Okay, that's what you are talking about.
Yes.
Okay, all right, okay.
Yes. So to the individual, though he will pay his interest payment will be charged with withholding tax of 8%. The general effect on the business will be less, as in the interest on the loan will be deductible for tax purposes. So that is what I will say about the loan too. Maybe I will write more when I sit with the paper.
Okay, definitely. If the writing there is between the pen and the paper, that one there, I believe that one, because that one things will come to your mind. Then you pour it on the paper. May I be saying you write whatever comes to your mind. At the end, you will not see your answer script, your answer booklet, they will not bring it back. The examiner may only comment that some candidate, they don't know what they are writing. They will not mention your name. They just say some candidate. So some candidate, they don't know what they are writing. So write. They will not mention your name that you didn't write it well. No. You don't know what you're writing may even help you pass the exam. So whatever comes to your mind, write it. So that is the loan. If you provide the asset to the company as a loan, provide the asset to be used to generate what? The income of the business. The interest paid on the loan will be tax deductible. The interest is tax deductible. So that is one tax benefit that business will enjoy. Now, even though he himself, the interest paid to him will attract an withholding tax, that will only affect him. But the business as a whole, the business will enjoy the tax benefit of the interest. So what is the best option that is to go by?
If he's not selfish, then he should go for the loan.
Oh yeah, the loan is the best one, because if you go for the equity, the dividend that will be paid to him, the dividend will not be, it's not tax deductible. It's not tax deductible. So even though he is the majority shareholder, so you have to think of that. He's the majority shareholder. So you should go for the loan. Question 9. Let's move on.
And please, with the interest that is deductible, should we subject it to the sin capitalization listing?
No. That interest will not be subject to tin capitalization. No.
Okay.
Yeah, that interest will not be, because that interest
No,
is
even say the thing capitalization, when you multiply the 400 by 3, it will be more than the loan amount. So still,
okay.
it will not affect the loan
if
interest.
you multiply the 400 by 3, that will be 1/2. Is that it?
120. Yeah.
So it will be 120 over 1 million. So it will not even affect the interest. It will not even affect the interest. So thank you very much, my brother. Thank you very much. Let's go on. Question 9.
Question 9. Ravid Ghana Limited is a software development company with its registered office located at North Kaneshie in the Greater Accra region of Ghana. In March 2016, the company purchased a parcel of land at Toyarefa at a cost of 25,000 Ghana cedis. The company spent 5,000 Ghana cedis to construct a fence wall around the property and to complete title registration processes as
Auntie Agnes, if you are reading your mic,
Ghana.
your network, Auntie Agnes.
Is it better, please?
Yes. You are welcome. It's very better. It's very well, very better.
Okay. So where should I take it from?
Let's start for us. But let's see the requirements, what we are asked to do. We are to advise the company on the on the income tax implication of the realization of the asset, So we have to advise the company, Ravid Ghana Limited, on the income tax implication on the realization of the asset. Okay, so you start from the beginning for us, please.
Okay. Ravid Ghana Limited is a software development company with its registered office located at North Kaneshie in the Greater Accra region of Ghana. In March 2016, the company purchased a parcel of land at Oyarifa at a cost of 25,000 Ghana cedis. The company spent 5,000 Ghana cedis to construct a fence wall around the property and to complete title registration processes at the Lands Commission. In May 2017, the company also purchased an office building at Medina, valued at 100,000 Ghana cedis, as well as a Toyota Hilux pickup, valued at 100,000 Ghana cedis. In February 2018, the board of directors of the company decided to dispose of the parcel of land purchased in March 2016 and the office building in order to raise money to finance the purchase of strategic assets. The company engaged the services of a valuer to determine the market value of the land located at Oyarifa. The company paid the valuer 5,000 Ghana cedis for services rendered. In August 2019, the company sold the parcel of land and the office building in a single transaction for 200,000 Ghana cedis. At the time of the sale, the market value of the land was 50,000 Ghana cedis and the office building was 150,000 Ghana cedis. The written down value of the building was 70,000 Ghana cedis at the time of the sale. Required. Okay, you've already taken that part.
All right, thank you very much. So this question is on what? What is the examiner trying to test here? Realization of asset, is that not it? Realization of assets. And when you realize an asset, what is the tax implication of realization of asset? So in general, what's the tax implication of realization of an asset? Before we start the question. What's the tax implication on realization of assets? Before we start solving the question. I'm listening, I'm waiting. Auntie Agnes, what's the tax implication of realization of an asset? When you sold an asset within a basis period, what do you have to do? I'm waiting. Who is helping us? Is my mic off or what is happening? My mic is on, yes. Loud and clear.
Hello.
Yes, I can hear you.
Yes. What I remember is that the company will treat it as they bought it back again.
Asset,
And then
realization of an
Wait.
asset, they will treat what like they bought what back again. What you are talking about is not relating to this asset. This one is a depreciable asset. Yeah, it's office building and what? And they did what? They bought a land. Land is not even a depreciable asset. Then an office building, and the Toyota Helios is a depreciable asset, and no. Where you are going is if you have interest in mineral rights, it's different from this one. Auntie Agnes.
Oh, okay.
Where you are going, if you have interest in, let's say if you have shares, you have shares, you have substantial interest in mineral rights or petroleum rights, that's the one you will treat as if you buy it back. So you compare the consideration, the cost. So it's assumed that you sold it and you bought it back at the consideration received. That is normally done for equity, yes, for shares.
But what she's saying, we remember we bought some land at Oyare Fine. We say it's not good. We want to buy another. We sold it and buy another, and we
That
treat it
one,
as house.
oh, that one, that's what the question said. The question said that the same amount was used to bought the land at different places. Yes.
Yes.
That's what the question said. That the value was used to bought land at another place.
Yes.
Yes. So if that's what the question said, then that is good. By this case, that's not the case. No.
Okay.
That one, the question stated that the value gotten from that land was used to bought land from another place. That assumption is different from what she's saying. It's different from what she's saying. What she's saying, they will not tell you. The question won't tell you that they use the money to bought land. No. That one is when you have shares, when you have interest in mineral rights, interest in petroleum rights, and you have shares. When you sold the shares, the assumption is that you sold it and you acquired back. So you have to calculate the new equity. You have to calculate the new equity. It's different from this one. This one is very simple. It's just realization of the asset. You bought assets, then you sold it back. You compare the consideration received. So you calculate either gain or loss on the realization.
Loss
on the realization. So you have your consideration received. You compare it with the written down value. With the written down value of the asset. Then you know that if you are making a gain, you know that if you are making a gain or you are making a loss. That's all. But
and when you make the gain, what is the tax rate?
When you make the gain, you add the gain to your chargeable income and tax. Gain or realization, you add it to your chargeable income and tax. If you make a loss,
it's not difficult.
It's not difficult. Just something simple. And if you make a loss, you are allowed to deduct that loss from your chargeable income and pay. But in this question, the question is talking about realization of combined assets. That's what the examiner is trying to do here. But it doesn't change the principle. You see this question. So let's digest the question. 111. So they bought a land at Oyarifa for 25,000. So that's the cost of the land. So the cost of the land is 25,000. That land was bought in 2016, and they spent 5,000 to construct a fence wall. So what do we do to the 5,000? So should I solve the question, or we should just explain and move on?
Please, let's solve it.
Okay, all right. So let me see. Let me see what I'll do. It's my screen. Good. So that's question what? Question number 9. So
Are you the one providing the feedback?
I'm not sure. It's Mr. Nathaniel Kweku Debedebedebe.
Batoango.
Is that what?
Kweku Batoango.
Batoango, that's the name, eh? Okay. So that is question 9. So we are to advise on the tax principles on the realization of the asset. So first, the name is Ravid Ghana Limited. So let's get the cost of the asset. The cost. So you must first of all find the cost. Now, how do you get the cost of the asset in general before we come to the question? What constitutes cost of an asset, cost of a depreciable asset? Before we come to the question, if you know that, then you can solve the question very, very easily. So the cost will include what?
Which will include the cost of purchase.
The purchase price.
Any other cost incurred to put the asset into use.
Exactly. Any incidental cost incurred, incidental cost, and any expenditure for altering, improving, or maintaining the asset, that are relevant to put the asset into its use. Is that not it? And if this one is relating to realization, so any cost you incur to sold the asset, any cost to sell the asset. If you incur any cost before you can be able to sell the asset, you have to add that cost to the total cost before you compare it with your consideration. So in this question, what's the cost given to us? So let's do the land first. So we are doing the land. So the land was purchased at how much? The purchase price was 25,000. Is that not it? They spent how much? They spent 5,000 to construct a fenced wall. Is that not it? Then they incur what? Additional cost to value the asset. You see, the company engaged a service of a valuer to determine the market value of the land located in the Oyari farm. The company paid the valuer 5,000 for the service. So cost of valuation. So you have valuation cost, which is 5,000. So the total cost will be what? That will be 35,000. Is that
Hello,
what?
sir.
Yes.
Yeah, please, I was thinking the valuation was right before the sale, or
Yes, it was right before the sale. But for you to calculate your gain or loss on the realization, you incur this cost, you incur the valuation cost before you sell the asset. So you must include it to your total cost.
okay. I thought it would be like cost to sell, which will affect consideration.
Definitely. So yes, it will affect consideration. So while you add it, all these costs will affect consideration. It's the total cost that you compare to the consideration.
Okay.
So you can add it. You have to add it to your total cost of acquiring the land before you compare it with the consideration received. Or what you are saying, you can deduct it from the consideration before you now have to deduct the other costs. Are you okay?
Yes.
But for it to be easy for you, just add it to the total cost before you compare the total cost to it's the same approach, the same thing. Before you compare it with your consideration received.
Okay.
All right.
Thank you.
So this is the total cost of the land. Is that not it? This is the total cost of the land. What about the building? What's the cost of which asset have they sold? The company sold the parcel of the land and the office building. Okay, in the single transaction of 200,000 Ghana cedis. The Toyota Hilux was not disposed. Okay, this was not disposed. So this will still be in their book that they will be enjoying capital allowance on it. Good. So they sold the parcel of land and the office building in a single transaction of 200,000 Ghana cedis. So the cost of the land of the building will still remain how much? How much will be the cost of the building? How much will be the cost?
100,000.
How much will be the cost of the building?
After disposal?
No, before disposal. Which one is after disposal?
Because okay, they say at the time of the sale, the market value of the building is 150,000.
So that is before they dispose it. So that will now be the new cost of the building. So the new cost, which is the market value of the building, will not be what? 150,000 Ghana cedis. This is what you compare with the consideration received from the building. This is what you compare. So this is the market value. So it means, no, this is not the cost. No, I'm coming. This is the market value. So it means if they want to dispose of the building, the value for the building will be what? Will be, that's not the cost. It will be the market value. So that will be the consideration rather. That will not be the cost. No.
It's 100,000.
Is it 100,000?
Yes.
Is it 100,000?
Yes.
What is 100,000?
No, it's 70,000. Won't the building depreciate?
Sure.
You are giving the written down value of the building. At the time of the sale, written down value was 70,000 Ghana cedis. So it means the building has depreciated. The building was acquired in February. Was acquired in May 2017.
My phone.
You say what? You have done what?
It's 70,000.
It's 70,000. So that's the written down value of the building. So the building to be the written down value, which is 70,000 Ghana cedis. So the written down value of the building is equal to 70,000 Ghana cedis.
So what are we trying to ascertain right now?
We are trying to do the gain, but we have two assets. Mind you, the assets were sold in a single transaction. So if you want to determine the gain, you must split the consideration received based on the market value of the asset at the time of sale. Then you compare that to their cost or to their written down value. So we are trying to determine the gain on the realization. The two assets, the land and the building, were sold in a single transaction amounting to what? 200,000 Ghana cedis. So it means you must what? Split this value, the 200,000, based on their market value. So it means the building's market value is 150. So we are going to compare the 150 to the 70,000 and determine the gain. Then the land value was 50,000. So we are going to compare the 50,000 to what? What was the cost? 35,000. That was the cost. 35,000. Then we determine the gain. So let's calculate.
So before we compare with the written down value, are we not going to determine which part of the proceed belongs to building and which part belongs to land?
Yeah, that was what I just said, because we are told. That was what I just said. We are told that at the time of sale, the market value of building was 50,000, and that of the market value of land was 50,000. That of building was 150,000. The two give you the 200. The two give you the 200,000.
Okay.
So that one you don't even need to determine it again. It's given to you already. So it's the market value you are now comparing with the written down value and the cost. So let's calculate the gain. So the gain, let's calculate for land. So the consideration received, that is for the land, that is 50,000 Ghana cedis.
50,000.
Then we compare it with the cost. The cost. So the cost for the building is for the land is 35,000. We are making a gain of what?
15,000.
15,000. So this is the gain. So this gain, what's the name of the company? Ravid Ghana Limited must include this gain in calculating their income, their chargeable income for the year. Now let's go to the building. So the gain, that is the office building. That's the office building. So we have our consideration. of 150,000. Then we compare with the written down value. So the written down value is 70,000. So we have 80,000 as the gain on realization of the building. So the 80,000 must, Ravid Ghana Limited must include it in calculating their chargeable income for the year. Any question? No question, no question, no question. Question 10, let's move on.
Question 10. Although tax plan reduces the tax liability of their clients, the Income Tax Act 2015, Act 896, contains provisions which limit tax planning schemes. Required. Identify any 3 anti-avoidance provisions in Act 896 and discuss how each of these provisions places a limitation on the liability of a person to engage in tax planning.
Okay, so what are the anti-avoidance provisions? In the tax?
Capitalization.
So the explanation, that one, the pen and the paper will do it. Is that not it?
Definitely.
Okay. So the first one, you have tin capitalization.
With profit sharing.
So this one is the debt to equity ratio should not exceed 3:1. Is that not it?
Yes.
Then we have profit what? We have
Split. Something split sharing, profit split.
income split. This one, what does it talk about? The pen and paper will do the explanation, Abi.
No, that nothing there.
Nothing they were. This is the one that talk about if you are trying to shift your income to jurisdiction which is called tax havens. Let's say you have an income, so maybe you and your wife is in an area that they will pay less tax, so you try to shift your income to that area so that you will pay less tax over here. But the idea is that later you will go and reclaim that asset or reclaim that income. The next one we have what?
Arm's length transaction.
You have arm's length transaction. The explanation, try and know them. Very, very important. You have arm's length transactions. Which one again? You have the profit. You have the profit split. Profit sharing, rather. This one I talk about it already. Which one again do you have?
Undistributed profit.
The word is undistributed profit, not profit split, rather. Thank you, senior. The word is undistributed profit, not profit sharing. Thank you, senior. Thank you, senior. So the word is undistributed profit. So try another explanation. Question 11. Let's move on.
Question 11.
Let's do this. Question 11 is on mining. Then the next one is on petroleum sector. Then I think we will be good to go. I think we'll be good to go. Question 11. Anti-argument, let's go.
Okay. Crystal Mining Limited is a residence mining company operating in 2 mining areas in the eastern and western parts of Ghana under the same name, Alpha Limited and Beta, under the name Alpha Limited and Beta Limited, respectively. Crystal Mining Limited has a shared processing facility for the 2 mining areas. As part of the effort to increase its market its market share in the sector, it acquired 40% stake in the operation of Omega Limited, also a mining company in the western part of Ghana. Omega Limited's operations are in their early years, hoping to start production in the next 3 years. Crystal Mining Limited commenced commercial operation in 2021. The operational activities of Crystal Mining Limited for 2021 year of assessment is as follows. We have the gross revenue, cost of operation, the gross operating margin, operating and other costs, and the net margin. Add interest, net of tax, and then current account.
Okay, wait. Let's see. The first, what she has read so far, what are they talking about? I stood up, I just came, so I don't know what they are talking. What are they talking about? Okay, it's a mining company, eh? So which is operating in two mining areas, eastern region and western part of Ghana. So their name is Alpha and Beta Limited, respectively. So this Alpha and Beta Limited, they make up of the Crystal Mining Limited. All right. So what is the tax rule? What is the tax principle on having a separate mineral operations? There is a term for it. What the term used to apply to the principle relating to a company which is having separate mining operations? What that term? What the name? What is it called? Ring what?
Ring fencing.
Ring fencing or ring fenced. It means what? What does it mean?
It means charging or recognizing each separate mining concession separately from the other.
Are you saying all?
No, I didn't say all.
I thought you were saying all. I say all. Which one is the all? So it means that you have to treat each separate mineral right as a different. So you ring fence them. You make sure you calculate the cost and everything relating to each of them separately. Separately. So you can only do that when production commences. You know, mining operations, how many stages do you have in the mining industry? You have what? The first one is what? Okay, the first one is the recognizance. You have recognizance, prospecting, and what? You have recognizance, you have prospecting, then you have production. So it means you take the recognizance license up to a minimum of, I think you have it up to a minimum of 12 months. 12 months. So this one is only for research. You're just going to do a search. So you are going to take the license to go and search and see whether there is a mineral deposit in the area. Then after the 12 months, if you are able to detect that this area there is a mineral deposit, you come for prospecting license, which is for 3 years. So under the prospecting, you can excavate. You're allowed to use some machines, but just that you cannot do production. So this license will only allow you to what? To do the prospecting, do the excavating, and search. You can do some diggings to check that, okay, actually, there are mineral deposits in the area. Then while you are back, then you come for production, which is the mining lease, which is what we call the mining lease, up to maximum of 30 years. So what is the rule? What is the rules regarding the prospecting? We are revising, no? We are revising. What is the rule regarding the prospecting and the recognizance stage? If you incur any costs, you have any revenue at the recognizance and the prospecting stage, how do you treat it?
Put them in a pool.
Which pool? Swimming pool or what?
Swimming pool.
We put them in a single pool.
We call it single pool, not swimming pool, single pool.
Okay, so you put all the costs in one pool. You group all of them together. Is that it?
Yeah.
And if you have any income at that stage, what do you do to the income? You generate any income under the recognizance and the prospecting stage. How do you treat that income? You use that income to reduce
The income will be charged against any cost that is already in the pool.
So you use the income to reduce the balance in the pool.
Yes.
That's it.
Mhm.
So the cost that you have any income, you use it to reduce the balance in the pool. Okay. Then you carry that balance forward until production commences. Is that not it?
Commences. Yes.
Okay. So when production commences, what happened to that cost?
We charge it against the income.
You decrease, don't fire you. Which income?
I mean, you allow it for you deduct it though before you
That is from what income? That balance is there before you are starting operation. You want to deduct. What are you going to deduct it from?
so how will you do?
You capitalize it and grant capital allowance.
Charlie. I decrease and
You I know say decrease. That one also form what? The cost of the depreciable asset.
Yes.
So the capital allowance in respect of mining, what we are saying relate to both mining and petroleum, because it's the same approach. So the capital allowance is what? What is the rate?
20%.
20% on what? 20% on what? Straight line. Is that not it?
Yes, sir. Yes, sir.
20% on straight line. Okay. So this one, does it follow the grouping system, the class system?
Oh no.
All right. So that it means that you put all the depreciable assets together. Is that not it? You put all of them in a one pool, in a single pool, and apply the 20% capital allowance to it. The same thing relating to mining and mineral operations. Okay. Deduction is not allowed. Let's refresh our mind. Deduction is not allowed. If you incur any research and development cost, is it an allowable expenditure?
No, sir.
All right. Why is it not an allowable expenditure?
We assume that it's part of the record.
Which one is
It will be
assumed?
included.
There's no assumption here.
That cost will be included in the early stage of the thing. Is that recognizance and the what?
Prospecting.
Prospecting.
Okay, so that's the reason why you are allowed to do at the recognizance and the prospecting stage. It's only research you are doing. So you cannot come and tell us that after you start production now in a commercial production, you went and go by, you do some research. What research are you doing again? That you have not done under the recognizance and the prospecting stage. 4 years, then you come back and tell us that you are now doing another research. So that one will not allow you. It's not an allowable deduction. Let's come to financial costs and financial gain. What is the limit in related to natural resource taxation, both petroleum and mining operations? Financial costs and financial gain.
So the financial cost is equals to financial gains that they use to compute the income.
That's who used to compute. I don't. So they used to compute. So I don't know that's who used to compute.
But it's equal to the financial gain.
Okay, so it means that the
So if
financial
it
cost
is
then it should be
equal to financial gain, if it is more than the financial gain, then the difference will be added to the income and tax on the at the rate of.
you are not giving me an answer as a final SCAG tax student. You are not giving me the answer. So the excess will be carried forward for the next 5 years. You see, so if you incur financial costs, you have financial cost of 20,000. Then the same year you only get you have a financial gain of 10,000. We can only allow you to deduct the financial cost up to the level of the financial gain. So you can only deduct 10,000. So the rest 10,000, you add it back to your chargeable income, because in your computation of your net profit, you will deduct the two. You deduct the whole 20,000, because you deduct the whole 20,000 before you arrive at your net profit. So we only allow you the financial cost to the extent of the financial gain. The excess, you will carry it for the next 5 years. For the next 5 years.
So the financial gain, will you add it to your operating income?
Oh, gain, yeah. Why not? You add the gain to your operating income. It's a gain now.
Then it becomes zero. The effect becomes zero.
Yes, the effect will definitely become zero. Yes, it will definitely become zero. That's the reason why you cannot deduct the financial cost more than the financial gain. No. So you want the effect to become zero. So you only deduct the financial gain, the financial cost to the extent of the financial gain, so that it will become zero. We only charge you tax on the excess of the financial cost that you have incurred. So the 10,000 here is the excess. So you only charge you tax on the excess. So you only add the excess back to your taxable income and tax rate. Let's come to gain on realization of assets and minerals and mining operations and petroleum operations. So if you come to gain on realization of assets, it's the same approach. You have to calculate the gain. So you have to get your consideration. Then you compare with the written down value or the cost of the asset. Then you add the gain to your chargeable income and tax. Now, when you come to petroleum operations, this is the only difference concerning the principles between the minerals and mining operations and the petroleum operations. When you come to petroleum operation, disposal of assets. How do you treat it? Let me say proceed. Yeah, proceed. Proceed from disposal of assets. Do you calculate gain here under petroleum operations? You dispose of an asset, a petroleum asset, yes. So you know the cost and you know the written down value. Now you receive a proceed, which is equivalent to the consideration received. Under petroleum operations, do you calculate gain? Mining operations, mining sector, there is the gain. You have to calculate the gain. You have to compare the consideration to the written down value of the asset. Then the excess, which is the gain, you add it to the chargeable income. But when you come to petroleum operation, you don't calculate gain. You include the proceed. You include the total proceed. You add the total proceed to your income. This is the only difference. So take note of that. If you have any question, you can shoot. Then we will discuss it.
So what happens to the cost of the asset that you are selling?
That is none of our business. You grant to capital allowance on it. That cost, you will deduct it from your asset before we even get to grant to capital allowance. It means that you have that asset is no more there. So now how do you dispose that? You deduct it from the cost of the asset before you grant capital allowance. Is that not it?
Yeah, the reason why I asked is that you bought an asset at an amount and you are now selling it at a different amount. Now, instead of them to, calculate the cost that I spent on getting the asset and compare it with the proceed, then the difference is what is my gain. But they are not doing that. They are taking it as though the entire proceed that I got on the asset is my gain.
That is only peculiar to petroleum sector.
Yes, I'm referring to the petroleum sector.
Yes, that is the sector where government gets most of the revenue. So any asset you dispose there, we don't want to know that the cost you incur in that asset or not. So the principle is add the total proceed to your income so that we get our tax, so that we get more money. So let's solve the question. I'm not here to argue with you. So you agree with the paper, You will agree with the paper in the examination hall. Good. So let's solve the question. So as part of the effort to increase the market share, the Crystal Limited has now acquired 40% in the operations of Omega Limited. Omega Limited is also a mining company in the western part of Ghana. Now, there is a tax implication here. Let me see if I can recollect that. There is a principle that dividends paid by a resident company to another resident company, whereby the company receiving the dividends controls at least 25% voting power of the company paying the dividends. That dividends, will it be subject to tax?
No.
That dividend is exempt from tax. Is that not it?
Yes.
It's exempt from tax. Good. But this does not apply to mining sector, mining and petroleum sector. Because we want to mining and petroleum. That's where government gets more revenue. So you cannot say if you are a mining company, you own another company too, that you own shares in a percentage holding in another mining company. Then you receive, but it's related to companies, only companies that are into mining. So you can be a mining company, then you own shares or you have control in another company which is not a mining company. If that is the case, you will still enjoy it. The 25% voting power is still there. You will still enjoy it. But in this question, you see, Crystal Limited is a mining company holding 40% in what? Omega Limited. And Omega Limited is also a mining company. So if Omega Limited should pay any dividend to Crystal Limited, that dividend will still be subject to the 8% final withholding tax because they are both into mining sector. But in this question, if Crystal Limited, Mining Limited, should hold shares in another company, that company is not into mining, if the percentage holding is more than 25, any dividend that company will pay to Crystal Limited will be exempted from tax. So take note. The principles are many. I know you'll be confused, but we'll be fine eventually. We'll be fine. Any question? Do you have any other class apart from the taxation class today? Do you have corporate reporting or any class today?
6:30. Buying.
Which one?
Corporate reporting.
Then me, I'm planning to close at 6.
Oh.
Oh, you look
I
for.
thought you.
Oh, you look for.
I thought you do it at 4:30.
Which 4:30? It's even. It's almost 4. Hey, my time is gone. Okay. So if I'm able to finish then let me do fast so that we can finish the everything today. We still have about like 1 hour left. Okay. All right. So we can do something. All right. So let's move on. So this statement relate to what? They say Omega Limited operation are in their early stages of operation and hoping to start production in the next 3 years. That is Omega Limited. So it means that the company they are holding shares in, every information that tax is out, every information is relevant. It's not like open reporting, they'll load the information plenty. You don't even know what you even read and go crazy. Advanced taxation, every information is relevant. It means that the company that they are holding the 40% shares in, this company, they are yet to start operation. So there's no way they'll even pay any dividend to them. So Crystal Mining have these records for their 2021 year of assessment. Good. So let's move on. So we have our net margin. We have our net margin of 360 million Ghana cedis. So there's interest, add interest, that is net of tax, current account. Will you add this one to your income from mining? Would you add it to your mining income? Interest on current account, will you add it?
What does it mean?
Huh?
What does it mean?
They have current account that they owe the earn interest on. Which one is what does it mean? Let's move on. We'll get there. So they have a gross revenue. Okay, let me be solving the question because my time is going. My time is going. But I see. Let's do it. Let's break the question down before we start solving. That will help. Let's break the question down. So gross revenue included sale of an asset worth 2 million Ghana cedis, whose cost of acquisition was what? 1,287,000 Ghana cedis. Now, the gross revenue, you have to include the total 2 million in it. Do you have to include the total 2 million in the gross revenue?
No, we have to calculate it again.
Okay, so what do we do to this figure, the 2 million?
We have to remove it.
It was included in the revenue, so we have to remove it. Is that not it?
Yes.
So we have to deduct it.
Yes.
Okay, thank you very much. Then gross dividends of 400,000 was received from, what word is that?
Awesome.
Azam Limited, a company resident in Ghana, in which Crystal Limited holds 40% voting power. Now, Azam Limited engages in commerce. Engages in what? This question,
Commerce.
if you are not careful, you would engages in commerce. So this dividend, is it right that they should add it to their total revenue?
Not
No.
all.
Not what?
Not all.
Not all.
Mm.
So which ones do they have to include?
But the dividend will be subjected to no, it's in commerce. So
You are talking, that is the
it's
thing.
a commerce.
And the Assam Limited engages in commerce. So it means that
Yes.
this dividend will be exempted from what?
From tax.
From tax. So they don't even have to add it to their what?
To add
their
it.
gross revenue. So we do what?
So we have to subtract it.
So we have to subtract it. I just explained this to you. This one, they hold 40% voting power. It's more than the 25%. So it means that this dividend will be exempted from what? From tax. I talk and finish you. We are told here that the dividend was added to the gross revenue above. So we must take it off. Nothing will even happen to it. Nothing will happen to it again because it is exempted from tax. Revenue from, what word is this? Tailing. What's the meaning of tailing? Those who work in the mining sector, amounting to 1 million, was added to cost of operation. Why will you even add revenue from tailing to cost of operation?
What is tailing?
I don't even know.
You're asking why will you add it?
But it's a revenue. They say revenue. So why will you include revenue to production cost?
Oh, okay.
Yeah, I don't know what is the tailing, but it's a revenue. So why will you include it to your production cost.
In mining, tailing are the materials left over, the process of separating the valuable fraction from the uneconomic fraction of an ore. These are often stored in ponds or other disposal areas.
So that means the revenue relating to the mining operation, is that not it?
Yes.
So it should be added to what?
Should be added to revenue.
Not what? Subtracted from what?
Cost.
From cost of production, is that not it? So you have to go back and add it to revenue. Okay. Now, included in the cost of operation is the excess of financial cost from derivative of 2 million Ghana cedis over financial gain of what? 890,000 Ghana cedis. What does it mean? This statement, what does it mean? It means that in the financial cost, they have added the excess of what? The 2 million minus the 890. That'll give you what? 110. Is that not it? They've added it to what? To the operation cost. And they have deducted it. Should it be deducted? Should this cost be deducted from the operation, should it be added to the operation cost?
No.
It should be rather be what? Added to backward to the revenue. Is that not it? So they have deducted it. So we go and add it back. We go and add it back. They have deducted it from from the revenue. So we are going to add it back. We are going to add the excess back. Now for the acquisition of
they wanted to hide it.
For the acquisition of 40% stake in Omega Limited, they pay what? 4 million. And this amount was added to the cost of operation. Is that treatment right?
Why are they adding everything to the cost of operation?
I don't know. Is their accountant why? You know, be qualified now.
So they want to pay less tax.
Yes, that is it. They are doing it to pay less tax. We will readjust the account for them. We are the tax man here. We will readjust the account for them. This one should be added to the operation cost. So it will supposed not to be. So we what? This is a separate what? This is a separate, what? Mineral operation. Omega Limited. It's acquisition of different companies. So this one, it's not a cost that you have to deduct. It doesn't relate to the mining activities during for the year of assessment. So you add it. So you have to go and add it back. You have to go and add it back. Good. Let's move forward. Research and development, 1 million was deducted. What should we do to it? We add it back. Depreciation. Guys, my network went off, so I know. Papa. Sorry, my network ran away.
So you go catch him.
I'll catch him, Papa. Okay, let's move forward. Let's move on. I don't know where they go, sir. I go catch him. So we add the depreciation back. Is that not it? Then it's an excluded expenditure. So we add it back. Then overburden stripping. Overburden stripping. Is my mic on? Let me see.
Yes, you are here. You are being heard.
Shaft sinking cost of 3 million was what? Was added to the gross revenue. This one is a cost they added into as a way of tax planning, according to the accountant. This accountant must be sacked.
You don't know anything.
This cost was incurred prior to the access of this one. So what do you do to this cost?
They say it was incurred prior to access of resource.
In 2021.
Okay.
This one, are you confused? This cost is an asset, so we disallow it and then add it and then capital allowance on it. Why? This one too, you are confused.
Now I was thinking it's an initial cost before the start of business, but when I compare the 2 years, then I kept quiet.
Why you compare what?
The 2021 and 2020.
You kept quiet. Okay. So this cost is supposed to be, was it included in the gross, they say gross revenue. So you have to go and deduct it. You have to go and deduct it. It's supposed not to be part of revenue. So we have to go and deduct it from revenue. You have to go and deduct it from revenue. Okay. Additional information is given, okay, further information. Recognizance and prospecting costs, okay, amounting to 80 million was added to cost of operation. Should it be added?
Nope.
So we disallow it, we capitalize it and grant capital allowance. This one too, the 278,000 to the same thing. It's supposed not to be added. We capitalize and grant capital allowance. Okay. So let's solve the question. You are even done solving. Let's go to the next question.
Are you sure we are done?
But that's what we just discussed. Or as you write. The treatments are what we just discussed. So there's nothing else. Okay.
All right, let's continue.
Don't worry, we are moving on. So which question is this? Question 11. What's the name of the company? Crystal.
Crystal Mining Limited.
Crystal Mining Limited. But what is the requirement first? What are we supposed to calculate? We have to calculate taxes payable by Crystal. Okay, taxes payable. Okay, taxes payable. So what are the taxes payable? Let's refresh our mind fast. What are the taxes that you pay?
Royalties of 5%.
Okay, thank you very much. And the corporate income tax of what percent?
30.
You decrease. What is 30?
35%.
35%. 35%. Computation of tax payable. So the year of assessment is 2021, and the basis period is January to December 2021. Good. So let's move on. So we start with what? We start with the net margin. Do this one and get that free mark. What is the value of the net margin? Let me keep 3 zeros at the top. So the net margin is what? 300 and what? 60,000. We should do what? We should deduct the following. So we just look at it. What is the first thing that we have to deduct? They have included revenue from sale of an asset. So we have to take that one off. So sale of assets. How much is it? 2 million. So that is 2,000. What again? They have included dividends of 400,000. So we take it off. So we have dividend. Dividend 400. What are we deducting again? What are we deducting again? This one was added to cost of operation, excess financial cost. They've added something to revenue again. What is that? We saw that right now. Yes, overburden stripping. This one was added to gross revenue, so we have to take it off. Supposed not to be there. That is not its place. So let's take overburden stripping. How much is it? 3 million. So that'll give you 3,000. Good. Once we did that again, is there something we have to deduct from revenue again?
No.
Okay, so we now have to calculate our royalty payable. Royalty is tax deductible, so we have to compute royalty payable and deduct it. It's tax payable, so you have to compute it and deduct it. So let me do that calculation here. Workings. Computation of royalties. Now, how do you calculate our royalty? Royalty is 5% on what? Royalty is 5% on what?
On gross revenue.
On gross revenue. Only revenue from what? Only revenue from mining operations. Revenue that is generated from mining, only that one. If there is any revenue included that is from different activities, you take that one off. Only revenue from what? From mining operations. That's only the revenue that you charge the royalties on. So
yeah, then let's calculate and get our gross revenue before we come and calculate the 5% on it.
at this stage, okay, we can do that. We can do that. Is that not it? So the same thing I want to do down there. The same thing I want to do down there. But if I do that workings there to get that one mark. So what is the gross revenue? It's 1 billion. So let me go there. So why am I doing the calculation? So our revenue is what? Let me keep 3 zeros at the top. So that will be 1 million.
50.
You say what?
50,000.
What is 50,000?
The royalty.
You've calculated it already.
I thought it said 0.05 on gross revenue.
No, this revenue, there are things that they have added which are supposed not to be there. So we have to take those things from.
Kafra.
They've included what? Sale of assets. Of what? It's not 2 million. What we just did at top here? 2 million in the gross revenue. It's supposed not to be there. You have to take it off. Proceed from sale of assets is not from mining operations. So we take it off. That is 2,000. They've included dividend. Dividend of 400,000. You have to take it off. They've included overburden. Overburden stripping of 3 million. You have to take it off. You have to take these ones off. Then we add, let's add that one. Revenue from what? From tailing. It's a revenue from mining operations. How much is it? 1 million. It's not 1 million. So what is the revenue from mining operations to be how much? What will be the total revenue now? From mining. What will be the total revenue? Who's doing the calculation for us?
$995,600.
995,600. So calculate the royalty for me. 0.05 by 995,600.
So the answer 49780.
780. So this is the royalties. So you have to go and deduct it from revenue. So our royalty is 49780. Is there something to deduct from revenue again? I don't think so. So add this value from what will you get?
58780.
5 what?
8
58780.
80.
Somebody should confirm the figure for me. So why you deduct it? How much will you get? I hope somebody is confirming the figure. Why you less it from the 360,000? How much will you get?
Please, for the sum, I'm getting 55,180.
Is that what you are getting?
Yes. I don't know.
So confirm 55180.
55 180
180.
minus 360,000. You get what? 304,820. Good.
Confirm.
So now let's do the add backs. We add back. Let's add backs. So what is the first thing we are going to add back? Something that they have deducted. That's supposed not to be deducted. Which one is the first one? Revenue from, we have done the dividends already. We have done the first one. Just that we have to find the gain and add the gain back, the gain on the realization. Is that in place?
Yes.
Okay, but it was not done. So let's do the add backs. Then we'll find the gain and add it back. So the things that they have deducted, that they are not supposed to deduct. Revenue from amounting to tail was added to cost of operation. So let's add this one. This one was not added. How much is that? That will give you 1 1 million. Is that not it? That's my sheet. So revenue from dealing. So that will give you, put it here, 1 million. Good. What again? They have deducted the excess of the financial cost. Excess of the financial cost. We have to add it back. Excess of the financial cost have to be added back. So excess of financial cost. That will give you how much? So let me do it here. 2 million minus 890,000. That will give you how much? 1110. Is that not it? So this is 1 million. So this is 1110. Okay. What are we adding back again? So we've done this, Okay. Acquisition of 40% of Omega Limited, the amount they have paid. They deducted it, they've added it to the cost of operation. So they have deducted. So let's add it back. So that will give you separate mineral right. How much is that? 4 million. What are we adding back again? Let's add research and development, depreciation. The two, let's add it back. So we have research and development. Research and development is how much? 1 million. Then depreciation. Depreciation is how much?
6 million.
6 million. What are we, anything to add back again? Let's go back to the question. They have deducted recognizance and prospecting costs, the two. So let's add the two back. So that is 80 million and 78 million. So recognizance and prospecting. This one relating to Alpha Limited, so 80 million. Then the next one, if you like, you can add the two. If you add the two, maybe you may not get that the tick for the two. This one relating to Beta Limited. So you have to separate them. This one relates to Alpha Limited. This one is 78,000. Something to add back again. Let me go back to the question. Anything to add back? We have done this, we have done this, yes. Okay. So what will be the total?
No.
Are we not leaving something?
171110.
No, it's like we are leaving something. Aha, this 1 million here, have we added it? The interest on the account, we have to add it to their total income.
Yeah, very well.
Oh, okay.
Wow.
We have to add it to their total income. Like we are leaving that one off. So interest on current account, which is 1 million. So how much will you get?
172,110.
172,110. So why you add it by what to be the total income?
I can't see the top.
You can see the top.
476,930. 76,930.
930. Okay. Are we done? Is there something to deduct again? Is there something to deduct again? Are we done?
You have to work on the capital allowance.
Thank you, Senior. Thank you, Senior. Thank you, Senior. So let's do capital allowance.
And sir, please, we didn't add again.
Yeah. When we deduct the capital allowance, then we add again. We can, okay, let's add again. Let's add again. Or we can decide when we deduct the capital allowance, we come and add it. It's the same thing. So let's deduct the capital allowance.
We add income before we take out expenses.
Okay, so let's add the gain. So gain on realization. So that will be what? 2 million minus what? 2 million minus what? Minus 1,287,000. So that 2 million.
730.
1,287,000. 7 what?
13.
Okay, let me 713. Okay. So you have to less our capital. Okay, let me bring some space down. So while we add it, what will you get? If you add, what will you get?
Four seven seven 443. 77
477.
643.
643. Is that what it?
6
477
Yes.
643. Okay, so let's go and calculate our capital allowance. So let me go down here. So this is working 2. So this will be working 1. So computation of capital allowance. Good. So what are the costs? So we are giving recognizance. We are giving recognizance.
Okay. Then you have to be careful. Doesn't mean that the drawer is not closed. Like you don't lock it in. Because you have office desk or can kill one time. So if that's the case, you have to be very careful.
Charlie, you are disturbing the class. You are disturbing the class. We should be careful. So how much is for the recognizance, and that is Alpha Limited? Is, let me put 30 at the top. That is 80 million. Then recognizance and prospecting. Beta Limited. 78,000. What do we add to it? Overburden stripping. 3,000. What will be the total? So 161,000. So capital allowance,
Out of the R&D.
you disallow it. So that will be 0.2. Why you want to grant capital allowance on the research and development?
No.
Ah, okay. I thought that's what you want to do. And I said, don't even be around the exam.
30 to 200.
I said, don't even go around the exam. Where are we? So our capital allowance is 32,200. So what will be our chargeable income? Chargeable income will be what?
445,443.
4 forward.
445,443.
What is 445 forward?
That is the chargeable income.
Four, 445.
Yes.
Four, 45443. So calculate the tax for me.
Tax 155,905.05.
155.
905.05.
Okay. Let me confirm these figures. Okay, thank you very much. So this is our tax payable. Any question? We are done. We are done with the question. We are done. So they say the tax is payable. So what will be the total tax payable? So total tax payable. So it's the corporate income tax of what? What figure is that? 1,545,90 what?
905.05.
905.05. 905.05. Then we add the royalties to it. Royalty is what? 40 what? What is that? Okay, 49,780. What will be the total?
I think it's 700. 49,700.
49,780. What will be the total tax payable?
Why did we calculate the royalty? It seems Auntie Agnes is saying that it's 700. Oh.
Really?
Sorry, 780, sorry.
This is the right.
It's 780.
This is the right.
Yeah, I didn't check.
It's 780.
Okay.
Yeah.
All right.
So
She's my sister, so I have to defend her.
yes, you have to defend it.
205-685.
No
0.05.
Good. So what's the next requirement of the question? So you have to do what? Advise management of the company on when it must pay its taxes to the GRA. So once they pay taxes to the GRA, this is a mining company. No? Once they pay their taxes to GRA, on installment basis. So that is on quarterly basis. So they must make sure that at the end of every quarter, they pay tax to the Ghana Revenue Authority. Now,
And they pay all at a go.
You know, that's the reason why they pay. Many companies, they are part of the industry that do the self-assessment, that pay their tax on installment basis. So
okay.
They have to pay. They have to pay on the installment basis. The sanction for no adherence to no payment of taxes?
Is that general or in relation to the mining?
Oh, this one is general. If you fail to pay tax, what's the sanction?
We have penalties, we have interest.
Failure to pay tax will attract what? Is it penalty or interest?
Penalty.
Penalty.
Penalty of what?
Is it 75%?
Failure to pay tax.
Oh, okay.
How is it computed?
Ah.
One 125% of what?
Statutory Bank of Ghana rate.
Okay. Statutory Bank of Ghana rate. So that's how compounded what?
Annually.
You decrease. Today I be playing. Compounded what? On monthly basis. They play. They play. Just they play. Let's do question. I think this will be the last question. The other ones are written, so you go and read them.
We'll finish this one too.
Oh, yes. The other one, question 13 is on what? Surface rental. What is the rate? Let's discuss it. Then we do that one. Then last. Then we close.
It's time.
What is time? We are not meeting again. Huh? Or we should meet again and do the last recap. Huh?
Yes, sir. We should meet again.
We should meet again. Is that Robert?
Zadok.
Zadok. Hey, see Zadok.
Yes.
We should meet again and do last recap.
Yeah, we should meet again. Boss, baby, where do you need there? You say, I'm fine, so cry. So,
why? It is stars.
see stars.
Okay, don't worry. You'll be fine. You'll be fine. Surface rental. What is the rate? Huh? Surface rental. We know it's part of revenue to the government under petroleum operation. So for the initial period, the rate is what? 30.
5%.
This one is not in percentage, no. That is what you're talking about is the initial carried interest. It's carried interest. This one is surface rental. So 30 US dollars per square kilometer. Then first extension. These are the one that will help you to pass the exam. First extension is what? How much?
50.
50 per square kilometer. Then second extension.
75.
75. Then why you start development and production?
100.
How much?
100.
100 per square kilometer. Go and read on the stability agreement, the carried interest, which is normally we call the initial carried interest. Then we have the additional participating interest, which is normally the additional carried interest. This one, the rates will be determined at the time of signing the contract, at the time of signing the petroleum agreement. But normally
it's usually 5%.
5% to 7.5%. But usually it's 5%. The additional participating interest. It should not be more than what? 15%. Should not be more than 15%. So can they read
Should
on?
not be less than 5%.
Should not be less than 5% too. Yes. Should not be less than 5% too. Then this question, I think this one we've answered it last time. What constitutes Ghanaian permanent establishment? Go and read on permanent establishment. You may see question on it. Then taxation rules on permanent establishment. Then the last question, explain the following transfer pricing method. You have to do your best and read on them. Very, very important. Do your best and read on them. Yes, I.
With the transfer pricing methods, from the resale to transaction net margin method, I've been reading and reading, but I'm not getting it though.
You are not getting it?
Yes, sir.
Oh, really?
You can do it on it, yes.
Okay. I see. So is it the comparable? Let me try and see if I can be able to confuse you more. The comparable and control price method. You know the transfer pricing normally based on the arm's length principle. Is that not it?
Yes, sir.
The arm's length principle. What does the arm's length principle state? I remember. That means transactions between persons in a control relationship.
Yes, sir. Yes,
the
sir.
transaction should be the current market price, the fair value. It should be the prevailing market price. Is that not it? So when you are selling between a parent and subsidiary, the selling price should be the market price. Is that not it?
Yes, sir.
Should be the market price. So when their selling price is below the market price, then that means the excess must be computed and add back to the chargeable income of the company. Is that not the case?
Yes, sir.
Thank you. Now, these are the methods that you can use to reflect the arm's length principle. So the first one, the comparable and control price method. So under this case, you are going to compare by the arm's length principle. You know the factors that determine the arm's length principle. So the comparability analysis must be key. The comparability analysis. That means the product that is the subject matter must be able to compare. So you check the functional analysis. The functional analysis of the product. What function does the product perform? So the comparability, you are talking about the risk involved, either if you should be able to compare the risk involved in manufacturing the product. You are checking the cost, the market conditions, under which the product are being sold. If all the factors can be compared, then the price at which the goods will be sold to an independent person. So the price at which the parent will sell the goods to someone that is not in relation to, that should be the same price at which the goods should be sold to the subsidiary.
Okay.
So that is the comparable method, the
Okay,
comparable and control price method. So if the product, let's say you are selling iPhone, you are selling an iPhone. That's what the parent is selling to the subsidiary. If let's say the parent is not in Ghana, the parent is in US. The parent is a non-resident company. It's in US, and the subsidiaries is in Ghana. If the price of manufacturing the iPhone and the risk, the functions of the iPhone that the parent is selling to the subsidiary, it can be compared with the same phone, the same iPhone that the parent will be selling to an independent person. Yes. And the phone can perform the same function, the same analysis, everything. Then the price at which the parent will be selling the phone to the independent person. So if to the independent person, the price is, let's say, is $300,000. So it means that the parent should also sell the goods to the subsidiary at the same price. See, are you okay?
Yes, sir.
That is the comparable and control price. So the comparability analysis is very key over there. Do you understand now? Or you are
Yes, sir.
Or you are more confused?
No, I'm okay, sir, with the comparability.
Okay. So let's go to the resale. The resale price. Can somebody help us with the resale price? Can somebody help us with the resale price method? So you see the resale price method. The subsidiary, you are going to buy the goods from your parents, from the parent company. So the cost will be determined, the cost at which you bought the goods. So let's say you bought the goods at 5,000 Ghana cedis. Now you are going to sell the goods to someone who is an independent person. So your selling price. So let's say you are not selling the goods at, let's say, 6,000 Ghana cedis. Are you with me, Senior?
Yes, sir.
You are not selling the goods at 6,000 Ghana cedis. So it means that before you will charge your selling price of 6,000 Ghana cedis, you have added what? Your profit margin. Is that not it?
Yes, sir.
You have added your profit margin. So let's see the profit margin. You can determine the percentage here. What will be the profit margin here? I mean, the profit is 1,000 Ghana cedis. Is that not it?
Yes, sir.
So this margin you have added to the goods. This is the profit you are making. So the transfer pricing should be that the amount at which you buy the goods. So you now have to deduct the margin from what? From the selling price.
Price.
You don't have to deduct the margin. Maybe while you bought the goods, you've added some other functions to it. So if you want to know the amount at which you should sell the goods, the margin should be taken out of the selling price. Then the price you get will be your what? Will be your arm's length price. Is that okay? Yeah. Because you bought the goods, definitely you add margin to it. Yes, so to know that the arm's length price, the margin should be deducted. So you should deduct the margin from here. So that will give you the transfer pricing. So that's the resale price method. I don't know if you have my notes on it, my notes on the methods. I have some examples there.
Okay, sir. Okay, sir.
Then the cost plus method is the reverse of the margin. It means when you buy the goods, the cost plus method, when you buy the goods, you bought the goods at 5,000. This cost, you are going to add a markup to it. So when you add the markup to it, the markup will normally be your profit margin. In this place, you will deduct the margin before you get the arm's length principle. This place, under the cost plus, you add the markup. So when you add the markup to it, the amount you get is now the arm's length principle.
Okay.
Are you okay? So this
Yes,
is
sir.
cost plus method. So the cost plus move with markup. The resale method move with the margin. So you have to deduct the margin from the selling price. The amount you get is the transfer pricing. Then the cost plus, you have to add the markup to the cost price, the amount you get. So in the question, they'll give you that the company intends to add the markup of this amount. So when you add, you compute that markup on the cost and add it.
Yes,
Then
sir.
transactional profit split. Transactional profit split. So this one, what you do is, under this case, and each of these methods, there are some circumstances which you can apply them. There are some circumstances. I hope you know them. Because
No.
for the comparable and control price like this, if you cannot get a market whereby you can get similar goods and compare the price, then that method cannot be used. So for the comparable price method, unless there are the same goods, there are similar goods on the market which perform the same functions. And at that time, then you can use the comparable. But if you cannot locate similar goods on the market, then it will be difficult for you to use the comparable price method. Because under the comparable and control price, the comparability analysis there is very key. You have to compare the goods, their functions they perform. So if you cannot get it, no. So each of them, there are circumstances where you can use them. So you have to go and read on them.
Okay, sir.
You see, the profit split method, you can use it when there is no comparable, if you cannot get any comparable product on the market. So this way, what you are going to do is the transaction between the subsidiary and the parent. So it may involve maybe more than two companies. Maybe the subsidiary may also sell to a third party.
Yes, sir.
To a third party. So what you do is you have to try and identify the profit, the total profit of the transactions. So the transactions between the parent and the subsidiary, and between you have to determine the total profit. So you determine the total profit. So when you determine the total profit, then how would that profit be shared among the parent and the subsidiary? So you now have to share. So they'll give you ratio, or they'll give you proportion, or you give you the basis on which the profit can be shared. So when you share the profit to all of them, the profit shared, the profit shared now have to be deducted from the cost that each of them has incurred. So what you get becomes the arm's length principle. So in this case, you cannot determine there's no resale price, there's no cost plus method, there's no comparable product on the market. So you determine the total profit of the transaction. Then how are you going to split that profit among the parties involved? So when you split the profit, it means that the profit they have gotten on the transaction. So you don't have to deduct that profit from the total cost they have incurred. The amount you get is not the arm's length principle.
Okay.
Then the transactional net margin. This one is like the net margin. What is it talking about? The transactional net margin method. Wait, let me get my notes on that. Give me a few minutes.
Okay, sir.
Let me get my notes on that. Where is it? International Taxation and Transfer Pricing. Yes. Let me get my notes on that. So that will do some analysis here. Where is it? So the transactional net margin. So this one examines what? It examines the net profit margin relative to an appropriate base, such as sales. So you compare the net profit to sales, cost, or assets. That's, say first, you are writing on my screen, that a person realizes from a control transaction or transactions that it is appropriate to aggregate. So you identify the net profit, the net profit that the person you have gotten. So you find the net profit. Find the net profit. Now, this is compared with the result achieved by independent persons on a similar transaction. So when the persons that are in control relationship, you try to identify the net profit that the person has gotten from that transaction. Then you have to look for an independent person, someone who is not in a control relationship. Then you compare it. If the transaction is still the same, how much profit has the person made from that similar transactions? Then you get that profit. Then the main difference, so when you get that profit, you compare the two profits. You compare the two profits. So you compare the two profits, the differences between the two profits is now the arm's length price. So let's say the person's in control relationship, they make 2,000 as profit. And when you compare to similar transactions, the profit was, let's say, 3,000. So the difference is now 1,000. So the 1,000 should not be the arm's length price. Are you okay?
Yes, sir.
That is it. So you compare the profits. So you look for an independent person. Compare the profit that person has made. Then persons that are in control relationship, what profit has the person made? Definitely, persons that are in control relationship, their profit will be less because they will charge lesser price. So their profit will be less. Yes. So the difference is now the arm's length price.
Okay. Okay, sir. Thank you.
Yes. Then I think I talk about the profit split. You see, so the method identify aggregate profit to be split. So you identify the total profit that will be shared among parties in a control transactions, and then split those profits between the related party based on the community basis. So you now share the profits among them. Now, the profit to be split are the profits combined earned by the associated person. So while you combine the profit to be split, each of them, when you determine the profit, you have to compare that profit with their cost. Then what you get is the arm's length. So the aim of the profit is to determine the division of profit that would have been anticipated in our control transaction made on arm's length principle. So you now have to compare that profit to their cost. The difference is now your arm's length price. So I think the other ones I've explained to you, the cost plus and how you add the markup to it. Then the resale price, you add the markup. So if you need the notes, just hire me on WhatsApp. Let me forward it to you so that you can read.
Okay, sir. Thank you very much.
Okay, you're welcome, sir. Okay, sir. Where we did, sir? Should you solve? Okay, this one, go and solve it. It's not everything they will solve for you. But let's adjust. Let's go through it. Then you can go and solve it on your own. Question 12. So I won't solve it, but let's discuss it. Let's discuss it. Then you can go and solve it on your own. Let's discuss it. How the treatment will be. Well, if we are done with that, then I think you are good to go. So this company's Alpha Limited is into upstream petroleum sector. Petroleum sector, we know there are stages. You have the upstream, you have the midstream, then you have the downstream. The downstream, they are the distributors. Goyle and Co. They are the distributors. Okay. So the company is to the upstream petroleum sector, and the petroleum sector too, their activity is in stages. So they also have what we call they have, which one is the first one? You have development.
Exploration.
Exploration is the first one, eh?
Yes, sir.
Okay, so as we have exploration, then you have development. Then you have what? What the last one?
Production.
Production. Okay. Okay. So this person is into the upstream sector and commenced production in 2020. So production commenced in 2020. The accountant who is new to the industry provided the following extract for 2020 year of assessment. So the basis period is January 1 to 31 December 2020. And we are told that the accountant is new, so it should be ready that there will be some treatment that will not be in relation to the tax principle. So you have their revenue. So I think they'll ask you to compute the taxes payable. So you start with the net operating margin. So the net operating margin, 220,090,000 Ghana cedis. Now, what should we deduct or what should we add? Let's look at the things, if there's something to deduct or something to add. So we have, okay, so license cost is deducted. Should it be deducted? License, should the license be deducted? License, is it a deductible expenditure?
No. No.
No. Okay. So we add it back. Is that not it? So we add back. So the one that will be add back, I'll put A there so that I know this one we have to add back. Then exploration, are we adding? Are we supposed to?
Yes.
Are we supposed to deduct
No.
exploration?
No.
So we add. Then what we add, what do we do to it? What do we do to it? You capitalize and grant capital allowance. Is that not it?
Mm.
Development, we add back. We capitalize and grant capital allowance. Production cost is deducted. Is it in place?
It's in place.
Research and development, is it in place? Research and development, is it in place?
No.
No.
So we add back. So we have to add the research and we disallow. So we add back. This one is in place. Purchase of land, the cost was deducted. Is it in place? Land, is it deductible expenditure? We capitalize and grant capital allowance. Is that not it?
Yeah.
Are we together?
Yes.
So we add back. Okay.
Yes.
So we capitalize it and grant capital allowance. These questions are very, very simple. Then staff costs prior to production. Should we add back?
Yes, sir.
So we
Yes.
add back. So what do we do to it? How do we treat it?
It will be part of the allowance, the exploration and the.
Okay, so we add it and grant capital allowance. Staff cost during production.
It's in place.
It's in place. CIMIC data at exploration up to 31 December 2019. Should it be deducted?
No.
So we add and do what?
Capital allowance.
Capital allowance. Cost incurred in hire of geologist from a rivalry company at development. Should it be deducted?
No.
No.
So we add back. What do we do to it?
CA.
CA. We grant capital allowance. proceed from sale of asset before production in 2019. What do you do to it?
It's a revenue.
It's what?
It's a revenue.
Look at the word before production. You know?
Add back.
You add back and do what?
No, it was added. I'm sure it was.
You sure it was what?
It's not. It's a negative figure.
That means it was
Yeah.
deducted. Is that not it?
Yes.
So what do you do? How do you treat it?
They will add back.
No, you don't add back. It was used to reduce the cost. Is that not it? These are costs that they have deducted. Oh. These are costs that they are. So this one was used to reduce the cost. So should we add back? It was not deducted from the revenue, so you don't add back. The only thing you do is you have to use it to reduce what? The capital allowance pool. Is that okay?
Mm.
You use it to reduce the capital allowance pool. You don't add back because it was not deducted from the revenue. No. So you use it to reduce the capital allowance pool.
But per how it is treated, it is having an effect on the net operating profit.
Net what?
The net operating margin.
What effect does it have on it?
It will increase it.
Yes. It will increase
So
it.
are we not going to reverse?
No, you will not reverse. Why you grant capital allowance, it will not offset. The way it treated it means that I can hear you saying.
So this one will be used as a disposal when we are calculating the capital allowance.
Yes.
It will be taken out from the total pool of the capital allowance before we apply the rate.
Exactly, yes.
Okay, thank you, sir.
So why you do that, it will offset the effect.
You say in the mining and petroleum, any proceed on the sale of assets is treated as an income.
Yes. Yes. But this one, look at it. It's before production.
So it's in place. Is that it?
Yes.
And so mark it.
No, here is in place. But what you do is you use it to what? You use it to reduce the pool when you are calculating capital allowance.
All right. So you can mark it and write CA at this side.
Yes, you use it to reduce the pool when you are calculating capital allowance.
Okay, so you can now continue.
When you are calculating capital allowance, you use it to reduce the pool. Where are we, sir? Where are you?
Penalty.
Penalty. Is it allowable?
No.
So you do what?
We add it back.
We add it back. Fines. What should you do?
It's not allowable.
We add it back. Hedge gain. What do you do to the gain?
We compare with the loss.
How much is the loss?
14 million.
So this is the loss, 14 million. So the loss, 14 million. Then how much is the gain?
200,000.
200,000. So how much will be the excess? You go tire past this one, sir. You don't see anything yet.
13,800.
13,800. So you add this one back to what? Is that not it?
Yeah.
So you add the excess back. Is that not it?
Yes.
Okay, so you have to do that and add the excess back. The Christmas tree.
Which one is that?
You don't see her for here. Christmas tree. You know, maybe the accountant too.
That 3 that they've been putting in the office.
Yes.
So you can't do that, you know.
So we add back. What do you do to it? You grant capital allowance on it.
On the Christmas tree.
Yes.
Is it in relation to the money? Sorry, to the petroleum services.
But it's an asset.
Is it not that thing that they buy during Christmas celebration?
Somebody is saying, I can hear you.
You are confusing us.
I'm confusing you. On which
Christmas
one?
tree and asset. What
Christmas tree, why should it be?
What economic benefit are we going to get from it?
Look at the value. Look at the value.
It's expensive.
It's what?
Remove your case. Let me see.
The Christmas tree no more ton one.
Huh? So you want to you have to disallow it. That one there is not an allowable expenditure. It's not an allowable expenditure. But the benefit you can give to them is capital allowance.
Okay.
Look at the value. The amount is huge, 30 million.
But sir, this one is not a mining related business.
Oh, so, yeah, but any assets that the company have. This one I don't even know why the examiner put Christmas tree here.
See, my problem is you describing this thing as an asset.
It's not. Is it an asset?
You are the one who is saying it's an asset.
So what do you think?
It's not an asset.
So that expenditure will just go like that. Is that not it?
It's just like making a donation to a football club or a political party.
Okay. So it's not an asset. It's not actually it's not in relation to the production of the petroleum sector.
You remember the last time some people went to do some refreshments, you said that we shouldn't include it.
Yes.
And so what happened to that cost?
Thank you. I did the thing to test you guys your mind and see what you guys will say.
Oh.
You guys, you did fast. No, that don't say what. I'm gonna say this one you are confusing us. Okay, so you disallow it. Disallow it. You don't even mind them. Christmas tree. Who asked them to go and buy Christmas tree? Okay. Bonus payment to government. Bonus payment to government. What do you do to it? Is it an allowable?
It's in place.
You decrease. Who told it's in place? You add it and you grant capital allowance.
Okay.
Are you okay?
I don't even want to understand. Let me just get these things in my head.
How can you get this in your head? Bonus payment is a depreciable asset. Bonus payment is depreciable asset. Bonus payment is, where's that note? Let me see. No, it's not this one. I'm coming. Give me a few minutes. Natural resources taxation. Bonus payment. Let me show you. Capital allowance. Copy capital allowance. Let's see. Cost of depreciable assets. Let's see what are the things there. Cost of depreciable assets. So cost of petroleum rights, balance in the pool, then bonus payment made in respect of what? Can you see that?
Yes, please, I can see.
Okay, thank you very much. So let's move on. Where is my note? Okay. So you disallow it and you grant capital allowance. Proceed from sale of assets after production. What's the treatment? You include it in your income, is that not it?
Yes.
Huh? Who is saying what? Will you include the proceeds from sale of assets in your income?
Yes.
Okay. So what they have done here, what did they do? They deduct it. That deduction is in place. They use it to reduce the total cost. Huh?
Sure.
So what they have done is in place.
Yes.
Who is talking? Let me see who is talking. The way the person is talking, Vim no did the talk inside. Auntie Agnes. Vim no did your talk inside.
Yes,
Huh?
I think they did the right thing.
Okay. All right. Thank you very much. The next one is what? Payment for infraction of regulatory what? Requirements. What do you do? You add back, Abby. Which one is AC? Should we add back? You add it back. The marketing cost is in place. Letter of credit cost in connection with purchase of oil. Do we add it back? They give you letter of credit from your bank and you are treating it as a cost. So you add it back. We are talking about the hedge loss and the things already. Then you do your capital allowance. Let's come here. We have production in barrels. Okay. There is a finance lease here. So there is a rental payment of 15 million. How will you treat the rental payment? It's a finance lease. And it's for how many years?
It will be included as an asset.
As an asset. But each year, you have to find the cost. So that will be 15 million divided by 6. So give you what?
Isn't they calculate the cost for us or no?
This is the rental payment too. This is the rental payment, 15 million. And the
And
lease,
there's finance cost of 1,200.
the lease is for what? It's for 6 years. So each year, how much will be the rental payment? 15 million divided by 6.
2,500.
So
2.5.
2,500. So this is the year. So this one, you add it to the cost of the asset and grant capital allowance on it. Or you can calculate the capital allowance on it straightforward and add it to your capital allowance that you calculated. The finance cost. How will you treat the finance cost? The finance cost is the interest. Is the interest. How will you treat it? The interest is, but they have not done it yet. So what are you allowing? You have to do it.
Yeah. So we subtract it.
So that will be 1.2 divided by what? By 6. So how much will you get each year?
So that should be 200,000.
200,000. So this one too, you deduct it, you allow it. So this one you deduct it. When you do that, you are done. You don't need to get 100% before you pass the exam. You need 50. When you're able to do all these things out of the 20 marks for this question, you will not get less than 15. You will not get less than 15. It's not possible. So we've come to the end, the close of the class officially. If you guys want us to meet again, then we can suggest that one on the WhatsApp page. Then we will look for time. Then we do general revision. We come and take the things and see what we can do again. So we are done. If no questions, we will end the class here. If you have any question, you are confused about something you want to ask, you can ask before we end the class officially. Tomorrow, 1 to 5, the same time, the same venue, we have advanced audits. Last lecture, last meeting. Silence means consent, So it means we'll end the class here and we meet some other time. I wish you guys all the best in your exam. While you are reviewing your notes, you are not clear with something, you can just send me hello. You can just call me or send me a message. I will try and be of help to you. Try and be of help to you. So we end the class here and we meet some other time. I wish you guys